Hello, hello, hello. Can you guys put it in there we go. Hi, Dwayne. Hi, Conrad. Hi, I don't know your name. It says first and last. All right, awesome. Hi, Kevin. Great. All right, I'm just trying to figure out how to do the questions here. And it looks like I'm set. All right. So where are you guys coming in from? I would love to know, where are we all meeting in? Which part of the world are you guys coming from? Give me a quick in the question box where you guys are joining in from, because there's quite a lot of people here. So I want to hear you guys. I don't know where you're from. Where in Florida, Conrad? And Alabama, nice. Washington State. How is Washington State right now? Is it cold? Maryland, the Villages. I don't know that place in Florida. My parents have a place in West Palm Beach. So I know that area, that whole area really well. Boise, Idaho, nice. Upstate New York, where I was just in Platkill, New York, literally last week. And it was the last cold day, and we were outside that day, and then the next day it was beautiful. So where in upstate New York are you, Kevin? Wet, wet, and wetter. Yeah, I hear you about the Washington State. Oops. All right, guys. Well, I'm going to get into the presentation. Before I do, I just want to do a quick hello. Oops. This is me. Oops, hang on a second here. What's happening there? All right, this is me. I am Marina, the trader chick. And hang on just one second here. Okay, you're 15 miles from Albany. Do you know where Plaquemine Mountain was? I went to a really like a destination wedding there. It was really quite beautiful. Okay, guys. So today what I want to talk about is how to get over yourselves and to have fun in day trading. And I'm going to do this by showing you the 4 basic steps of day trading, because that's what it all boils down to. When you have the basics down, you can then expand and become much more creative and have a lot more fun. But before we do that, I do have a question for you. Who here actually has fun when you guys trade? Let me know the truth, because a lot of times we think we have fun in trading, and then at the end, it's not that much fun, right? Because we lose, or there's certain reasons for whatever, right? Like, how many of you guys actually have a good time when you trade? I know in the beginning, I thought I was having fun, but instead I was just having nothing but massive stress overload. But I have another question that I kind of want to put on top of this one. How many of you guys drive a car or have been in a car? I know it sounds a little bit, oh, come on, we've all been in a car. You'd be surprised, not everybody, but how many, right? I mean, when we get into a car, we have fun, right? But the shocking fact is that all over the world, there are gazillions of car accidents every year. It is an unfortunate fact, but it is a fact, right? Yet, every day when we get into our cars, we put on music, we jam out, we have a good time either on our own or with our kids, right? This is a normal thing. Or even worse, we text, we answer the phones. We've all done it. I know that I am completely guilty of it. We all get distracted in cars. And there are even more accidents with motorcycles. And this is literally how me and my kids sometimes have been on the scooter, including our puppy. So yeah, this is, but we still enjoy these things, right? We still enjoy these things. So here's the thing. How many of you guys have lost money in the markets? I know I personally have lost a ton. I mean, I've emptied out several accounts. It's an unfortunate fact, but it is a fact, right? And but here I am. I'm still having fun with my kids. I get to travel. I hang out with my husband. Why? Because when we get into a car, the chance of real life injury, it's there, it's real, yet we still have fun, right? But we treat losing in the markets as if though it is an actual deadly thing, right? We take it so seriously that it could kill everything. It could completely hurt us on every single level. But the fact that driving in a car can be, with injuries or fatalities, we don't take it as seriously, and we still get to we enjoy it, right? We go on road trips, we hang out. It's a normal thing. And once we are able to view trading as something that is not as serious, yes, we can lose money in it, but if you are in control of the amount of money you could lose, you're going to be telling the market, hey, you know what, I'm only willing to risk this much on a trade that I know works out 90% of the time, right? So that's the most important thing, is having that knowledge, knowing how to drive, knowing how to trade. And I'm not talking about, oh, that looks like a really great candlestick, I'm going to get in. No, I'm talking like for real, like really understanding the know-how. When you get into the car, you have the basics, right? You know where the steering wheel is, you know where the gear shift is, you know where the clutch is, you know where the brake is, you know where the accelerator is, you know where the windshield wipers are. You have these basics, because if you did not, the chance of you crashing and getting hurt is that much more elevated, correct? So having those things understood and just becoming automatic, you are able to be a good, strong driver, right? Trading is a lot like driving, but you don't take the same risk as you would normally. So if you understand the basics of trading, you will not end up crashing, right? You will absolutely understand what to do. And after years of learning with other people's strategies and following their own setups, basically, I was never learning how to drive. I decided to take control of my own charts, of my own car, right? And that is the most important thing, because a lot of times I find that people are in live chat rooms or alert rooms, and they don't actually learn how to drive their own car. They don't actually learn how to control their own charts. And what happens? This happened to me. I ended up losing big time. I ended up losing almost $4,000 in matter of 5 minutes. Why? Because I was sitting in a chat room. I didn't have a full strategy. I was live in the market. Somebody was saying, "Oh, the market, this is a great trade." I didn't fully see it, but if they're saying it is a good trade, I've been now trying to work on it for ages. I started to chase that trade. And of course, once you chase the trade, you're already in an emotional state of mind. What happened? I ended up losing, but it started to go the wrong way. And what did I do? I had a mental stop put in. I didn't even have a real stop put in, right? So what does that mean? We all know about these mental stops, right? It's the same thing as having a mental seatbelt on and telling yourself that you will save your baby when you crash, right? It's the same thing. Your ego will always win. So I ended up losing almost $4,000 in 5 minutes. And this was not my first time losing that kind of money. And on top of that, do you think I would have stopped? No, because I was already in a totally emotional bad place, right? So what did I end up doing? I ended up revenge trading for another 2 days with almost $2,000 more. So in the matter of 3 days, I ended up losing almost $5,500. Okay, so basically what happened is that I totaled my car twice, literally. Okay, and that's when I literally had an official breakdown. So here's what happens with breakdowns. Two decisions, and does not matter in what your breakdown is for. You normally have two decisions. You normally quit, walk away, you never do that thing again. In this case, never trade again, or you have a breakthrough. So for me, I ended up having a breakthrough. Have you guys ever watched that movie, Nacho Libre? Me and my family are huge, huge fans of Nacho Libre. And I feel that I could so relate to Nacho, especially during these times when I was just really fighting hard, trying to become a trader and not doing it well. So Nacho, he wants to be a luchador. Luchador is one of those Mexican wrestlers in the lucha libres, and he is desperate to be a wrestler, and he is terrible at it. And he goes to church one time and he's saying, "Lord, why did you give me this passion to be a wrestler and made me such a lousy warrior?" And literally, that's what I was saying almost every day for such a long time. I'm like, why do I have this passion inside of me to do this, but yet I feel like I'm so lousy at it? Well, needless to say, Nacho, obviously the movie, he ended up getting invited to one of the most important fights or matches, and he beat this guy. He was a total underdog. And that's kind of what happened with me as well. right? I ended up turning everything around. And how did I do that? Through a breakthrough. I ended up going back to the basics. One thing that I noticed is whenever I spent thousands of dollars with trade rooms and academies, but nobody ever went to the basics. Nobody ever talked about the basics or taught you the basics, right? Every time I brought up, can you please explain this divergence or can you explain this reversal pattern? I would either be ignored or I would be treated as if I'm supposed to be born with this information. So my breakthrough was I came back. I used to have 3 monitors and 10 indicators. I stripped all my indicators. I had no more indicators, just the bare naked charts. And I literally threw out 2 brand new monitors. I'm sure they went handy with the garbage men, but to be honest with you, I just went back to the basics and then I ended up studying them for years. And that's when I realized that the market actually speaks to us. It has a language. And once we speak that language, that's when we can actually work with the market rather trying to predict it or all these other things. Okay, so here is, I just want to do a really quick intro because we also forget to remember that sitting in front of the charts, that's not who we are. We bring our whole people, our whole selves to the charts. And you have to understand that because every single person that sits in front of the chart is viewing them differently because of who they are. So I am Marina, the trader chick. I'm an expat mama living in Antigua, Guatemala. I've been here now for 13 years and an expat in Central America for over 20 years. Before I became a trader, I was a fitness instructor and a travel writer. And why is that important? Because a lot of people believe they have to have a financial background or an economic background. I'm also trilingual. And the main reason why I say that I'm trilingual is that helped me recognize that the market actually has its own language. I was a Soviet Union refugee, so Russian is my main language. I was raised in the United States, so Russian is my mother language, English is my main language, and I've now been living in Central America for over 20 years, so I learned Spanish in my later years, and understanding and learning a new language. That's when I was able to see that the process of reading the markets is also like learning a whole new language. And the beauty of day trading, guys, you can literally do this from anywhere in the world. It's so, so great. And we travel. We travel 3 to 4 months out of the year. So this is an amazing, amazing way to be able to do it. Before COVID, I used to do a lot of in-person events, money show, Traders Expo. And then during COVID, I started to do a lot more events like Investors Expo online, simply because I now see that there's a lot more chance of getting out there and meeting more people and to be able to share with you guys. So today I want to talk about the basics of day trading, and that's how you're going to be able to get over yourself and have fun, because once you can master those basics, that's when you could totally enjoy trading. All right, guys. So let's get started so that we can get in our own cars and have fun adventures and not feel like we're going to get injured or crash. All right. And it starts with the 4 basics, just like in the car. Ready? So that they become more automatic. Before I do get into it, the entire presentation I'm going to be giving you guys, you can get at makingofadaytrader.com. You can get it here for free, makingofadaytrader.com. And Anna always sends replays, so you could have that presentation and then go back to the replay and go at your own pace. Okay, before we get into anything, if you're going to be a day trader, if you're really going to be serious about it, you need to have a charting platform. You cannot be a Formula One driver in a minivan. You cannot be a day trader if you're scrolling on your Robinhood. You need to be on a strong platform. And today there are so many wonderful platforms, but they're also the ones that you'll be able to get your universal indicators and so much more. Okay, I use 2 indicators, only 2 indicators, the MACDs and EMA lines. And that's the best thing of all, is that I have completely simplified my entire trading. All right, I use 2 indicators. One of them is the EMA, which is the exponential moving average, and my MACDs. I find the MACDs to be the least lagging indicator out there, and you always want to be on top of the market rather than lagging behind it. All right, guys, the basics. So what are the market movements? We all know that there are three market movements, right? There's the upward trend, there's the downward trend, and then there's the sideways trends, right? However, the sideways trend, I can pretty much guarantee that this is where 90%, if not all of your profits of the day get lost. Why? Because this is the consolidation area, the indecision area, the exhaustion pattern, the chop. And if we don't recognize it, we are not going to be able to understand when it gets out of those areas and also understand when not to take trades. So just understanding trending markets, we have the downward trend, then we have this indecision area, which becomes a transition area, and it changes direction. What is an upward trend? Pretty basic. Upward trend is each pivot is higher than the next, right? It's a bull market. The market is trending up. This is when you go in for a long. This is when you enter at a lower price point, exit at a higher price point, and take that profit in between. I am surprised the amount of people that don't know the difference between long and short and are in the live market, and they are losing simply from that basic fact, right? You're going long. That means you are entering low, exiting high. All right, that you are buying. Now, what is a downward trend? It's literally when each pivot is lower than the other. And this is when you go in for a short. This is when you are selling in the market. You are entering at a higher price point, exiting at a lower price point, and you're taking that profit in between. And day traders, we make more money like this than we do sometimes going long. And especially with the crashing markets that have been going on for the past 6 weeks, a lot of people are making a lot of money shorting the market. All right, you need to understand what that is. It's entering high, exiting low. It's a bear market. That's when you want to take advantage of it. Now, I personally am a scalper. That means I go for much smaller profits. And because of that, I'm also able to get into the deeper corrections, right? So we will have an overall market, and then you could have a deeper correction, which could give you a mini trend or an immediate momentum, and I could optimize and monetize that quick correction before it decides to continue in the same direction. All right, guys, let's talk about consolidation areas and transition areas. I literally call them the trader's worst enemy. And once you learn how to spot them and avoid them, you will be able to save yourself so much money and start taking really powerful trades off of them. All right, so what are these areas? This is that indecision zone, right? Where the market was moving in one direction and now doesn't really know what it's going to do next. Is it going to continue or is it going to completely transition, right? So what happens a lot of times, like I keep on saying, is that day trading, anything in financial markets, but day trading especially, is very emotional. And when people start to see these consolidating areas, they start to tell stories to themselves. They start to tell these lies. So they're seeing this and they're saying, you know what, the market's been moving up all day. It's gonna continue up. I'm gonna go long, even though the market right now is consolidating. Or there's the contrarian type of a trader, which is just what I used to do. You know what, the market's been going up that much. It's got to correct. I'm gonna short it. I'm selling. Because I was a contrarian trader, I was saying that it's not going to continue. Here's the reality. The market is going to do what the market is going to do, regardless of what you think it should do. So when you see something like this happening, what do? I'll give you a little clue. We as traders have only 3 things that we need to do. Only 3. I know it sounds very basic, right? But 3 things. 1, we need to know when to get into the market. Number 2, we need to know when to get out of that market. And number 3, and probably the most important and the least used, is knowing when to stay out entirely. Okay, I know that there's this misconception that day traders have to be in and out of market, in and out all the time, blah, blah, blah. But the reality is the best traders maybe take 1 to 3 trades per day because it's those significant, strong trades. So understanding that and knowing when to sit out is going to be your best friend. All right, so understanding when these consolidation areas happen, and I understand getting in the beginning and being stopped out, but once you see it really happening, and I'm going to show you exactly how to spot them, you need to stay out. because you can get stopped out even on a smaller consolidation such as this, and they happen all the time. Okay, so then how do we recognize these areas and how do we stay out? So the market tends to respect areas. It revisits areas, and we as the individual retail trader have to respect with it, right? And what are these areas? They are support and resistance areas. The way I like to call them, it's our safety gear. You know, a Formula One driver knows that during a racing season, 25% of the racers will either have a massive injury, massive accident, or even a fatality. You'll never see a Formula One driver get into their car without a helmet on, without a fireproof uniform, and once they're in the car, to not put a seatbelt on. It will never happen, right? It's completely ludicrous because they need to protect themselves however they can, right? Why is it that trading, 95% of people fail, yet they're still not protecting themselves? This is our safety gear, support and resistance areas. Why? Because this is areas where the market respects. And if it's revisiting these areas, it could stop you out if you think you're going to break that area. So what is a resistance area? Resistance area is the ceiling of the market. You might be going up in a good, strong way, trending up, and all of a sudden it starts hitting this area over and over and over again. Anything 3 times or more, that's when the area is really solidified. Okay, so resistance area is the ceiling of that area. Okay, that's a resistance area. What is a support area? Support area is the floor, right? So you could be trending down and all of a sudden it starts hitting it over and over and over again. This is the support area. It's the floor. It could literally stop the market and completely transition it. You need to understand it. And the most important thing is you guys need to draw these areas in. And I'm not talking about a mental resistance or a mental support area. It's literally the same as a mental seatbelt. You need to have these drawn in. And any platform today allows you even the most simplest drawing tool. You could just do a line because that will allow you to remember what is going on. Now, you could have channeling markets, right? With the resistance and the support. And do you really want to be in a market that looks this crappy? No, never. You do not want to be in a market that looks that bad. You do not want to be in a market that looks like this. Save your hard-earned money, guys. Save it. There's a reason why money doesn't come so easily. It's because we have to work for it. If we could just get in and out constantly, and especially in crappy markets like this, all you're going to do is literally just keep on donating your money to the market. Now, a lot of times people ask me, well, how do I spot these areas before it's too late? This is the beauty of market speaking loudly to us through reversal areas and divergences. And this is the cool thing, guys. This is free. This can be found on any and every platform there is. Okay, that is the coolest thing of all, and it's free. And all you have to do is understand and listen to it. So, what are these areas? Reversal areas. Double tops, triple tops, double bottoms, triple bottoms, head and shoulders. And when you couple it with divergence, forget about it. It is just golden. So here's a reversal pattern. Now, what's really important to understand is reversal patterns are not 100% indicative of being a reversal. What it is indicative is that the market is slowing down and has a very high potential of reversing, but does not mean that you need to start to put in your order weightings for that reversal. And when you see a divergence like this, you see the divergence is my price action is moving up. Meanwhile, my MACDs are moving down. What is it showing me here? It's showing me that the market is losing its strength. Do I want to be putting my money on something that's about to die out? Hell no. And nobody should. And you shouldn't be guessing. Okay, and you shouldn't be saying, well, it was going up. So what? It stopped going up now, and you need to read what it says. Now, when you bring them together with this double bottom and divergence, that is just magic. You need to completely stay out. I personally stay out entirely when I see divergence. As you can see here, it's going down here, but it's totally flat on my MACDs. I'm already staying out because I know the chances are of it, slowing down, going into indecision, or changing is really high. And I'm very conservative. Why be aggressive? People who are aggressive, they never stay long in their trades. They end up losing way more than they end up winning. Okay, so let's put this all together. Remember, all of this that I'm showing you guys, I'm giving it to you for free in this right here. Just go to makingofadaytrader.com. makingofadaytrader.com. All right, guys, let's talk about the breakout areas, because here's the reality. Breakout trades are the most powerful trades out there, okay? But if you don't know how to spot it, you're not going to be able to catch it. So what is a breakout trade? It's literally when you are moving up or down, it does not matter, and there is either a resistance or a support area. When you are moving in the same direction, right? Here you are moving up, all of a sudden, massive channeling market, massive area here. And then boom, it breaks out. It continues in that same direction, right? It's like driving a car and all of a sudden you're stuck in massive traffic and there's a detour and you don't know where you're going. You're freaking out, but all of a sudden they're like, you know what? This is a great place for you to go. Get back on that highway and continue in that same direction. All right, that's what a breakout is. But if you don't have your support and resistance areas drawn in, you are never going to be able to catch it, right? So this is how I use my indicators. So as you can see here, I have a really flat area. The MACDs, this dash line, this is where it's super slow, no energy at all. It's losing all its strength. But then boom, look at this, it breaks through. And look at the huge spacing with my MACDs from the zero line. This is showing me that there is a lot of strength. You see here? And when I use my EMA lines, is this is where I put in my order weighting, because you need to be able to put in an order weighting. You need to be in control of the market by telling the market where you want to enter. You do not just randomly go in because it's a big bar. No, you put in and you tell the market, this is where I am entering. And here is extra confirmation for that. Okay. Here's another bonus, I guess, trade that I absolutely love. I call it the initial reaction trade setup. So here we have a market that's been trending, and all of a sudden it hit that resistance, that ceiling, and it's just not breaking through. But all of a sudden it broke through and transitioned. This is when I will be getting in, because you want to get in as early as possible with the trade. Somebody is doing something next door, and I think it fell into my property. Anyhow, so again, go to makingofadaytrader.com. This is where you guys could follow along. And now I want to do a little bit of a live analysis with you guys. So this is my chart right here. I personally use NinjaTrader. As you can see, the market's been toppling down pretty much every day. Today, it's kind of like in a bigger, it's like in a big channeling zone, right? It's not a complete channel. It's trying to go here or there. And it's definitely a market that I would be trading, especially when it is this wide, right? So, but I need to draw these in, because if you look carefully, these areas are really respected. First, we have this area around here, right? And then it literally hit to the same area. And then we have, because I'm a scalper, I go for smaller areas, right? So this is a very narrow channel that I would not be in. And this was the majority of the market hours, like in the morning hours, because right now it's what, 12:30. So this is, you know, right in the morning session. It was kind of between here. And then it flew up finally around 11:30 a.m. And it was a really great moving market, but now it's kind of hitting it again. And this is normal behavior, right? After it takes a little run, and now it's kind of hitting it back and forth again right here. No, it does not mirror the market at all, Mark, at all. Look at what's going on here. Okay, here we have a moving market going up, right? But all of a sudden, it gives me massive divergence, right? Look, right here. Look at this pivot. And then look, it's now completely flat on my MACDs, yet it's still moving up, right? Oops, hang on. It's still moving up. What is that telling me? Wait a minute, it's starting to slow down, and look at that massive move down. It barely moved here, but it is a potential. It's starting to tell me that it can, and boom, look what happened. It did go down. So it's definitely not mirroring it at all. So when you start to understand how to use divergence with it, and especially with reversal patterns, which look at this amazing reversal pattern right here, this double top. Oh, what's going on here? Hang on. And look at this. Okay, something is wrong there. There we go. Okay, look at that. Look at this. Oh my God. I mean, this is just beautiful. This is the market speaking to us in its words. And when we start to listen to it, that's when we could work with it. And it's telling us, you know, it's about to do something. It's losing complete steam. And then boom, it runs. And look at the MACDs here. It's showing me this is an amazing place to get in and enter the market. Okay, so hopefully that makes sense, because if you guys could learn how to use basic, simple indicators together, it is magic. It's truly, truly magic. Okay, oops. All right, so that's how I personally use the market. I have to always have my areas drawn in. I focus on what the market is telling me in that moment. But here's the reality, guys. We have everything that we absolutely need, right? We have these seminars, we have summits, we have YouTube channels, we have books, we have all these different, I guess, channels of getting information, which is great. But then at the end of the day, how do you know that you're doing it right? How do you know what you're learning and putting together is the right thing, right? All of this is great. But the real question is, you keep on asking, is like, how do I actually really get started and have that consistency? And I get this question from beginners, from seasoned traders all the time. What can I do to become profitable consistently? And that is literally what we are all searching for. And I've always found that the number one reason why people are not consistent yet is because they don't have the full grasp of the basics. And once you understand the basics, that's when everything changes. It's literally like when I was learning Spanish. You know, I learned with, my name is Marina, I like to do this, I like to, you know, what is your name? But I would never enter a conversation with 6 Spanish speaking, fluent Spanish speakers and try to understand what they're saying. And that's what a lot of traders are doing, or people that want to get in and become traders. They start to enter the market without understanding even how to say, hi, my name is. Okay, it's literally getting into a car and not knowing where the steering wheel is, not understanding how to shift your gears, all of that. You'll never get past, you know, you'll never really drive well. And if accidentally you start to drive, miraculously, you will crash because you're not going to understand how to do that properly. It is kind of like, you know, somebody who's never been in a car before and just sits in your car and you're telling them, all right, put in your seatbelt, that's going to save your life. And if they've never heard of a seatbelt, never seen a seatbelt in their life before, how are they going to be able to put it on? And all it's going to do is make them really stressed out, because they're like, okay, this thing could actually save my life, but I don't know what it is. And a lot of people who are starting, they're too shy to ask, can you please show me, where is the seatbelt, right? And that's the most important thing. And this was my own sad truth. I spent over $20,000 on my own trading and trainings and everything. And I was struggling because when I did ask those basic questions, I was always treated poorly, or like I'm supposed to know this with, you know, and that's how I ended up losing all that money. And what happened? I ended up quitting. Like I said earlier, I totally quit. I actually walked away for several months. But the reality is, that we are all here and we are all bit by that trading bug, and it will never stop itching. And you know why? Because deep down inside, we all know that we can do this. We can do this. We can do this. And that's when I decided that I am going to do this. And that's when I decided to get back to the basics. So today, when I was, now that I'm teaching people, I have this one student come to me and they're like, you know, you really remind me of Coach John Wooden. And I was like, who's Coach John Wooden? He's like, he was a legendary basketball coach and he's not alive anymore. And I wanted to find out what he is and why my philosophy and my way of doing my trading is so, such a resemblance to him. And this is what I found. His entire philosophy is when in doubt, get back to the basics. This guy has had more accolades, more wins than any other coach to this day. And he trained superstars. These guys were winning national championships, NCAAs, nonstop. Yet every time they began their season, he would start with the basics. How to tie your shoe, how to roll up your sock, how to dribble the ball. Why? Because it doesn't matter all that you know. Because if your shoe isn't tied properly and you're out on that court and your shoe does something funky and you sprain your ankle, guess what? All your knowledge means nothing because you're going to be sitting out because of your sprained ankle. So you got to get back to the basics. You got to always have them. Now, I have a special offer just for the people that are here today, just for you guys, because I am so grateful that you made it here, took that time out. I have a special offer, and it is my introductory course, Bootcamp for Day Trading. And this can be done on any apparatus, on any tablet, phones, desktops, laptops, you name it. All of this is for $97. You could go right now, bootcampfordaytrading.com, bootcampfordaytrading.com. So here's something I want to ask you. What can you get for $97 that will bring you that same return on investment? Go golfing for a day? Maybe for one person. You can't even do it with a whole family, right? How about inviting some friends out to dinner or family or lunch? Because today, $97 doesn't even buy you for a two-person a decent lunch, right? So for return on your investment for $97, this is what I'm going to break it down for you. Bootcamp Day Trading. You get the simplified day trading package. I know a lot of people really struggle with setting up their platforms. I give you a tutorial, and on top of that, I help you set up your platform. So you never have to worry about how does this work? What do I do? I help you. It doesn't matter which platform you are on. They are all similar, and I have been on the majority of them. We will also completely be breaking down and dissecting markets entirely, understanding those magic telltale signs, reversals, divergences, but really working on them, truly honing this and understanding, because those will save you. Understanding and spotting support resistance areas, divergences, because this is the magic of everything. When you start to recognize when the market is slowing down so that you are preparing yourself for either the breakout, which is one of the most powerful ones, or for a transition trade, and importantly, staying out of those fake out breakout trades, right? Because they are real and they can actually really, you can lose a lot of money with them. And on top of that, you guys will get an unlimited access to the curriculum. All of this is valued at $1,600. Okay, all of this, but you'll get it for $97. Bootcampfordaytrading.com. Here are what some of my students have to say, and I have students from all over the world. I just finished this boot camp right now. Best money I ever spent. You are the only mentor that checks that work. It is absolutely amazing. Thank you. I'm enjoying our boot camp and I am learning every day. I want to share something really important with you guys. Really important. Like I said before, how do you know you're doing it right? So the question is, yeah, you might be getting all this information, but who's there to help you to really understand, right? What I'm offering for a very limited time, for included in this one-time payment of $97, 1 month, one-on-one mentorship, one-on-one unlimited time with me, feedback, one-on-one mentorship, because that is what's going to bring you to that top. And I have one extra bonus for you. You'll get to be in my live trade chat room, and it's me, not any moderators. It's all me. We implement everything we're learning, taking live trades in the live market. You'll get 30-day free membership in that with me. All of this is valued at $2,600, but for you guys, $97. Bootcampfordaytrading.com. Bootcampfordaytrading.com. Here's what you guys get. Everything in the course, 30 days one-on-one mentorship, and 30 days live trade chat room. Okay, and you know what? And you guys know, so this is not something I'm coming up with as a joke or anything, but $97 is less than the average trade. And you guys know that, right? It's less than the average trade. So $97 will get all that, plus the working with me live and also being in my live trade chat room. One-time fee, nothing else. Bootcampfordaytrading.com. All of this course is 10x the return on investment on going out to meals with your friends, going to play. Instead, you could take them out for 100 dinners like this after you have applied everything. And you know what? One of my students, he just came back, he just took this, and he said the next day he went in and he did $700 worth of profit. Okay, but here's the thing. I can only take 25 students. Because of my one-on-one mentorship, I'm only able to work with 25 students. So go here, bootcampfordaytrading.com, and actually you can begin with $59, right? 2 payments of $59 and you get access to everything right away. $97, guys. So let's go here together right now. $59 to start or $97 one time. Okay, and if you guys have any questions, let me know. So here it is. 1 second, let me, oops. So bootcampfordaytrading.com, bootcampfordaytrading.com, and this is where you will be. You can start with $59 or $97 and you'll get everything that I have told you guys. So bootcampfordaytrading.com, and you can get started right away. And honestly, let's make your money really work for you guys. If you have any questions, please let me know. Otherwise, let me know any way I could help, and I'm looking forward to seeing you guys inside the bootcamp. Thank you so much, Anna, for having me here, and thanks everybody so much for being part of today's presentation, and I hope that you guys will learn something. And again, I'm excited to work with you. Bootcampfordaytrading.com, and thank you. I am Marina, the Trader Chick.
Okie dokie. Well, thanks again for having me, and I'd like to give a big shout out to Anna. If you're not familiar with Anna, she's from the Ukraine, and she's been made to leave her home country, and she's now living in Poland. So I give my blessings to you and your family and your countrymen. So thanks Anna, for having this event, and I always like doing it with you and what you present to us. So thanks again. So what we're going to talk about.
Thank you so much, Larry. Means lots to me.
Oh, you're quite welcome. My prayers go out to you and all your fellow countrymen. So God bless. All right, so let's get started trading options today. So that's what I'm going to focus in on here, is just the amazing benefits and advantages of trading options. So the following presentation is purely for educational purposes. Any stocks, options, futures, or ETFs mentioned does not constitute advice and should not be construed as a recommendation. So, trading is a business of probabilities, basically. And to be successful at trading or even investing, it really comes down to controlling your risk, and that's what really wins the game. So I think we see pretty good examples of that over the last, month or so, how risk control can really help your overall trading or investing portfolio. So by knowing and better understanding how to manage and control that risk, it's going to make a dramatic and positive difference in your trading or your investing performance. And the best way to do this is through the options. So using options in your trading or investing. Now, option trading has so many more advantages than just trading the outright stock, but as you probably know, it's a bit more complicated as well. But once you understand the benefits and the advantages of options and option spreads, you're never going to really look back and want to do anything other than trade options. Now, a stock option is a contract that gives you the right, but not the obligation, to buy or sell shares of the underlying stock before a certain date, called the expiration date. Now, options are used for either, you can use it for income or revenue, to speculate, and also they were created for hedging risk. So options are known as a derivative because they derive their value from the underlying asset class you're trading. And you can do options basically on anything. Now, a stock option contract typically represents 100 shares of the underlying stock, but also options may be written on any sort of underlying asset, so from bonds to currencies, from oil to other commodities. Now, why would you want to use options? So first off, for speculation. And speculating with call options instead of, say, buying the stock outright is an attractive way since options provide leverage. An out-of-the-money call option may only cost a few dollars compared to the full price of 100 shares of a stock. So it can really be a great way to, speculate on something with a lot less cost and risk actually than if you did the, full underlying shares. Now, options were created then for hedging, and they were meant for hedging back the, commodity hedging back in the, gosh, I guess back in the 60s, the first option contracts were created. And I remember the option contracts were created back for oil back in the 80s, and that's where I started out on my option side of things. Now, options, again, were created for hedging, and hedging with options is meant to reduce the risk at a reasonable cost. So think of using an option like an insurance policy. Just as you have an insurance policy on your house or your car, option can be used to insure your investment against the downside or downturn or downside risk. So say you want to buy a stock like Apple, but you also want to limit your losses. So by using maybe put options against that, you can limit your downside risk on the stock and enjoy the upside in a cost-effective way. And for a short seller, call options can be used to limit losses if you're wrong and the stock moves higher. Now, the types of options, we're going to either have what we call an American or European option. And the American option can be exercised at any time between the date of purchase and the expiration date, whereas a European option are different because they can only be exercised at the end of their option cycle at expiration date. So they're typically cash settled, whereas the American option, you actually are exercised and you actually take the delivery in some extent of the underlying security. Now, when we look at the American and European options, the distinction between the two has nothing to do with geography. It's only based on early exercise or expiration. An American options typically carries a higher premium than the European option because the early exercise feature is desirable and commands a premium for that. Now, expiration liquidity, what is it we're looking for? So when we're trading options, we want to categorize them by their duration or the extent of the life of that option cycle. So short-term options are those that expire generally within a year. We define it as that way. Now, a long-term option with the expiration greater than a year, these are classified as long-term equity anticipation securities, or you might have heard their LEAPs. So LEAPs are identical to a regular option, but they have a longer duration as to how long they last. Now, options can also be distinguished by when their expiration date falls. So sets of options now expire weekly, on each Friday, and at the end of the month, or even on a daily basis. And index and ETF options sometimes offer quarterly expiration dates as well. Now, let's take a look at put options versus a call option. So when we're trading puts and calls, what's the difference for a buyer or seller? For the buyer, a call gives the right to buy the underlying stock. A put gives the right to sell the underlying stock. And for the seller, a call gives the potential obligation to sell the underlying stock, whereas the put gives that potential obligation to buy the underlying stock. The overwhelming majority of options you'll probably see is that they're going to usually expire unexercised. And that becomes a huge advantage for option sellers versus buyers. So, it's good, when you get into option trading, you want to understand the benefits and the advantages of both the sell side or buy side of options, because they have different advantages and benefits to either buying or selling. Now, how do options actually work? The value of an option contract is all about determining the probabilities of the future price or future price events. And this is calculated based on the option pricing model. So it's called the Black-Scholes model. And what goes into that model is basically these components: the time decay of your option that goes into the model, implied volatility, and the underlying security value. So these are the three major components that go in, and the model calculates what that particular strike price would be based on those components. So the more likely something is to occur, the more expensive the options would be that profit from that event. So for example, the value of a call option is going to go up as the stock goes up. This is the key to understanding the relative value of an option. Now, when trading options, the most important option factor or component comes down to time. And time value is what we refer to as the extrinsic value of the option. It's the premium that a rational investor is going to be willing to pay over the current exercise value or intrinsic value based on its potential to increase in value before expiring. And this probability is always going to be greater than zero. Thus, an option is always worth more than its current exercise value. So when we look at theta, which represents time, what it tells us is, first off, the less time there is until expiration, the less value of an option. Now, this is because the chances of a price move in the underlying stock is going to go down as the expiration draws closer to its expiration. This is why options are a wasting asset. So if it doesn't go the direction you need it to do and you're just long an option, it's going to decay each and every day until eventually it's going to go to zero. So if you were to buy a 1 month option that is out of the money and the stock doesn't move, that option becomes less value each and every day and eventually is going to go to zero. Now, option theta is what tells us how much an option price will actually diminish over time. So this is the rate of time decay of your stock option. And this time decay occurs because that extrinsic value or time value of the option goes down each and every day as we get closer and closer to expiration. So for example, if you had an option contract that said, you look at your option chain and it shows you that it has a theta value of minus 10 cents, that's basically going to be losing $10 per option contract every day, even over the weekends and holidays. So remember, one option contract is equivalent to 100 shares. So if it's minus 10 cents, that's $10. Now, if you're a buyer, or let's say a holder of an option contract going into a 3-day long weekend, and let's say you bought an option contract for $1.40, which is $140 for that one option contract, and the option contract had a theta value of minus 10 cents, you're going to find out that that option price is not going to be 140 at the end of that weekend or long weekend. It's going to be 110 if it doesn't move. So instead of that 140, you've got it valued now at 110. So you've lost that value, and that's the theta decay striking against you. Now, when we look at theta, they have two different characteristics. So option theta is going to be either a positive or a negative kind of characteristic or value to your option. So all long stock options, such as let's say you're long a call or you're long a put, they're going to have a negative theta value. So what that says is that it indicates that your position is going to actually lose value each and every day as you get closer and closer to expiration. So if the underlying security was to go sideways and you're long an option call or long an option put, that value is going down because of that theta decay or that negative theta value. And the flip side of that is all short options. So if you're short a call or short a put, that has a positive theta value. So it indicates that position is going to gain value each and every day if if it goes sideways, it goes nowhere. So you're gaining that value from that short option. Now, by expiration, options are going to have no extrinsic value left, and all out of the money options will expire worthless. So this rate of this daily decay all the way up to the expiration is what we call the option theta value. So by understanding option theta, it's an extremely important part of the components for pricing and for the application of option strategies that seek to profit from this time decay component. So if you look at this diagram here, this kind of gives you an idea of time and a graphic idea of how it goes down over time. So if you were to start out with an option, 120 to 90 days out, it's going to have very, very little theta decay, very small time decay. So as a buyer, an option, the gift of time is in your favor. So you want to, be longer duration. But you can see that as you get closer to expiration or day zero, that curve starts to really go down. And when you get 30 days out, that's where it really accelerates. And then we have these weekly options we can take advantage of for this, this theta decay that gets, very exacerbated and increases as we get closer and closer to day zero. So as a seller of options, this can give you that big benefit. And as a buyer, you need to be aware of the accelerated theta decay that can hit your option price. Now, when we look at implied volatility, the next major component of price, it's basically what the marketplace is implying the volatility of your stock will be in the future based on the price changes in an option and calculated based on the option pricing model. So it is this volatility that when we use the pricing model for pricing, it's going to yield us a theoretical value of the option equal to the current market price of that options. Again, this is theoretical, but this is, when we're trading options, this is the best place to start. So we're going to want to know what the implied volatility is, what the option theta is, and those are going to go into the option pricing model to give us a price. So the implied volatility is basically a forward-looking measurement and differs from historic volatility because historic volatility is calculated based on known past returns of the security, whereas implied volatility is based on the future potential forecast theoretical value. Now, volatility will be greater. Greater your price swings will increase the chances of an event occurring. So therefore, the greater the volatility, the greater the price of your option. So as an option pricing component, when implied volatility goes up, that increases the price of an option. So option trading and volatility are intrinsically linked to each other in this way. So on most US exchanges, the stock option contract, again, if you're buying or selling, is equivalent to 100 shares. So that's why you must multiply the contract premium by 100 to get a total amount of what you'll be spending on an option, either a call or put. Now let's take a look at option pricing and these components and how they affect the option price or the option premium. So when we look at the value of an option, again, it comes down to your pricing model, which has the time component times the implied volatility times the intrinsic extrinsic value. And once you know these variables, then you're going to be ready to price out that option, know what the option premium should be, and then know what option strategy that you want to use. So when we look at these components and how they flow through, this is a really good diagram to show you. So this is based on, like, let's say a weekly option. So every Thursday we get a new weekly option series. So we're looking at the value of the option is going to be that time component times the implied volatility component times the underlying value, which is made up of the intrinsic extrinsic. Okay, so we're going to keep this a constant of 1 and just look at the impact that time and volatility have on the price of your option. So if you come in day 1, Thursday, so today we have a new option, weekly option series. So today we would have 100% time in that option. And if we then had let's say an implied volatility, I plugged in a number here of 300, that in this stays constant, you would have an option price of $300. Now, as you can see, when you come in Monday after the weekend, etc., that option time decay component is cut in half. Now it's only 50%. And even if you increase the implied volatility in this example up to 800, you can see that your premium really didn't move much. So let's say you had an option premium or implied volatility of only 200, then you can see your option value is going to be only $100. So the big takeaway is that you see that time and implied volatility, those two components are wasting assets and they're going to go to zero at expiration. So this is what we can take advantage of if we're selling options. And if you're buying an option, you want to be definitely aware of that. But it can also be a benefit to you as a buyer because you're going to have cheaper options as we get closer and closer to expiration. So these are benefits that you can really take advantage of when you're trading options versus if you're just trading an outright security, like a stock or something like even a future. Now, let's take a look at some of the top option strategies. And basically, the ones that we're going to be most concerned or interested in are going to be either you go long calls or puts, vertical debit spreads, vertical credit spreads, a butterfly, a calendar diagonal. So I'm going to go through these variations, and these are some of the very top kind of popular option strategies that are really beneficial for so many different market conditions. So first off, long calls or puts. So these can be used for your day trades, swing trades. So swing trades are what I kind of define as a trade that could be on for a day up to 10 days, something like that. You have a cycle swing. Or they can be used for long-term trend trades. So generally, when I'm looking at calls or puts to buy, looking at buying something at what we call a 50 delta, or maybe a little bit more in the money at 70 delta. They're going to be defined risks with unlimited profit upside. So if you bought a long call, your premium paid is going to be your risk, and your potential upside is unlimited. Whereas, if you buy a put, you also have defined risk, and then your upside potential is down to the price of zero. Now, the vertical debit spread is great because it can also be used for day trades or swing trades, long-term trend trades. But what the debit spread will do is going to define your risk and lower your capital at risk even more. And that's based because you're adding another seller or component from the sell side to it. So it's going to cap your upside, but it's also going to decrease your capital that you're putting out versus if you're just long a call or long a put. Now, the other thing is the vertical credit spread. So this is kind of the total opposite of your debit spread. And these can be used for also day trades, swing trades. Going to be best used for credit spreads, or when you have the implied volatility is going higher. That means you're getting higher premiums, and that's good for vertical credit spreads if you're selling premium for, say, revenue. They're going to also be defined and takes as far as your risk, and it's going to take advantage of time decay. Any sideways price action and your profit is capped. So the credit spreads are great if you've got a range-bound market, you know what your range is up or down, and you want to take advantage of that by selling premium. So let's look at the vertical debit spread first. So again, the vertical debit spread, we can either have a vertical bull call debit spread. So this is one where you're buying a call and selling a higher strike call that'll be lower in price, but this is going to offset some of that premium cost from the long call, and also offset some of that theta decay. And then the other one is what we call the vertical bear put debit spread. So this entails buying a put and selling a lower strike put that will be lower in price to offset some of the premium cost of that long put. And these are all done for debit, so very defined risk and capped as far as the profit potential, but really great risk reward kind of profile. So if you look here, this is an example of a vertical call debit spread. So in this example here, this would be like you're buying a call here. This was on the NASDAQ index right here. So let's say you bought this call here. So you're long this call at $1,010, and then you sell a call here at $1,020 right there. So it's $10, which $10 times 100, that gives you the spread width here is $1,000. Okay, so one option contract would be a spread width of 1,000. Now, in this example, your cost of this debit spread is $300. Okay, so $300, and then the difference is your potential, or not your potential, but is your potential profit, or your profit. So if this at expiration closes above this 1,020, you're going to make $700, which on that risk of 300 is a 232% return. Or the other way to look at it is you're putting up $1 of risk to make $2.33. So it's 2 to 1 basically. So that's the beauty of a call debit spread or a put debit spread. We're defining our risk, lowering our capital at risk, and have a really decent return anywhere from 2 to 3 to 1 times the risk that you put up. So that's what we call a positive risk ratio. Now the opposite is if we look at, well, let's go, the next one is let's see here, let me get rid of this drawing tool. There we go. Now the next one is your vertical credit spread. So this is the opposite of the debit spread. So here in this example, we have 3 types of credit spreads that are typically used. We have what we call the bear call credit spread, the bull put credit spread, and the long iron condor, which is a combination of the bear call credit spread and bull put credit spread. And these will have what we call a negative risk ratio. So a bear call credit spread is going to be best used if you think the market's going to go down, or it could just go sideways because you're short premium. So even if it goes sideways, you're going to make money and win on that trade. Now it can make money over time, even if the stock stays stagnant. So basically what you're doing is you're selling a call while at the same time buying another call with a higher strike in the same month or duration or weekly series to offset that risk of the short call. So you're not just naked short. So here's what we call a vertical bear call credit spread, and here's an example of what we call a negative risk ratio. So 1 second here. All right, so in this example, let's say this is also $10 wide, the same kind of profile. So here you're selling the 1,020 short strike. So here's your short a call, and then you buy to cap that risk, that 1,030 right there. Again, it's $10 wide times 100. So the spread width based on one option contract is $1,000. And here your premium, your potential max profit would be the premium received at $200. So that gives you your potential profit of 200, but then your risk is the difference. And so your risk is going to be $800. So you're basically on this type of trade, when you're doing credit spread, you're risking more than what you can potentially make. So here you can see you're risking 800 to make 200, which is a negative. You're risking $4 to make $1. So this would make a 25% return. So the question is, a lot of traders, when they're starting out buying options and things, they would say, well, why would you ever do, kind of a risk profile like that? Now, these are called probability trades, because once you understand and learn about delta, typically when you're selling an out of the money credit spread, a lot of times what we're doing is we're selling what we call a 20 delta. So let's say if we sold a 20 delta short strike here, when we look at a delta, that's equivalent to 100 shares. A full delta is like you own or control 100 shares. And if you sold a strike price that had a 20, that means 20 delta, that strike price represents, out of the money, you're at 20 delta. The probability of your trade being a successful trade would be the reciprocal of that, 80%. So if you were to sell a short strike which had a 20 delta, 80% of the time, the probability, 80% of the time, the market price would close below that short strike. If a call, or if you sold a put, it would close above, theoretically, 80% of the time. So that's why when you go into a credit spread, you've already got this kind of what we call high probability trade set up. So you get this negative risk kind of ratio here. So that's the vertical bear call credit spread. Now, the next one is the opposite, would be your bull put credit spread. And this is going to be one you're going to use if you think the market's going to go up. And the great thing about this, though, it doesn't have to be, you don't have to be perfect on that direction or timing. So if it still goes sideways over time, you're still going to make money if you're short a bull put credit spread. So what this does is you sell one put while at the same time you're buying another put with a lower strike and in the same month or same duration. So again, it will have a negative risk ratio as well. So here's an example. This was on Apple. So here is a bull put credit spread. You're bullish Apple. You think Apple's going to go up. So in this example, was selling the March 149 put that had the 20 delta. And then to cap your risk in case you're wrong, you're buying the March 144 put below it. So you can see it's a $5 wide spread. So $5, which would be $500 spread width, and your credit received is $105 right there. So that's your max profit, is that premium credit received. So your difference, your risk is the difference, which would be $395. So in this case as well, you're risking $395 to make that $105. So here's your short strike right here at 149. So you're short that put here at 149, you're long this put to cap that risk at 144, and your max profit, if it expires, below your short strike here, this would be your 20 delta. If it expires below that, 149 at expiration, you keep the $105 on that risk of 395. That would be a 26% return, or you're risking $3.76 to make $1. So that's a negative risk ratio there. So that's how the credit spreads work. And then just the other combination of the two is if you did an iron condor credit spread. So this is basically the combination of your bull put credit spread and bear call credit spread together. So this is going to be one that you can use when you feel the stock is going to be maybe very tight in a trading range. You've got a defined range above and a defined range below. So the iron condor is kind of ideal strategy for this kind of premium collection or collector of premium, and you're seeking to minimize your potential losses in the event the stock moves, either one way or the other, but you're going to make the credit if it stays within your range of that credit spread. again, it's going to take advantage of that time decay, theta decay, and volatility crush that options have going into expiration. So you can see from this profile, this risk profile, it's that combination. Here would be like you're going to be short a bear call credit spread. Let's say here, you're short a call, long a call there. And then the opposite or other part of it is you're short a put credit spread on the other part of the trade. So you're trading a range bound kind of price scenario. So let's say the market, is, let's say $100 seems to be a very good resistance level up here, and then below you've got maybe $90 as very strong support. So these are great kind of situations for doing credit spread iron condor, where you're playing a range between these two areas of 100 or say 90. So for example, here, if you did a $500 wide spread, and let's say you bring in $50 here, so you got that credit, and then you bring in another $50 here, you bring in that credit, your total credit received is 100, received $100 credit, you've got your spread with the $5 or 500, so your risk is 400. Okay, so you're gonna make more than if you just did a credit spread and you brought in 50, and then your risk here is 450. So if it goes out between the two short strikes at expiration, you keep the full $100. If it goes out anywhere in between, that will be reduced, but you still have a positive, profitable trade. Now, if it falls then below your zero line, that's where you start losing money, but it's capped at your risk on the trade is capped. So again, the beauty of all these options, if you use spreads, is that you're going to have a capped risk type trade setups. Now, another really favorite question: how does the probability of spread factor into making the trade? Does a 1 to 2, 1 to 3 consistently have the same statistical probability correcting typo again? Yeah, so that's a great question, because the way to look at any trade, the way I look at it, is I always look at risk first. So what I'll do is I'll look at the different variations of different trade strategies, and I'll look at, okay, what is the risk on this trade? And you'll see the different, like when we go through this, the butterfly will have a very low risk versus that credit spread, which has a high risk actually when you look at it. So what I'll do is look at the risk reward. I'll look, okay, if I've got a risk of $100, say my $100 risk is 100, what is the potential return at expiration on that 100? So if say potentially you did a debit spread and your potential return is 400, then that is a great, that's a positive risk ratio. So that's one to compare. So that's one. And then if you look at another one, maybe it's got less of return on that risk, and then you can decide which one you like. So that'd be like a 4 to 1, versus maybe you had another option strategy where only maybe you made 300 and your risk is 100, so that's 3 to 1. Or maybe you have a negative risk ratio where you're risking, you potentially might make the 100 from a credit spread, but you're risking 300. So you can then compare and decide which risk ratio you want, positive risk ratio or negative risk ratio for the market condition you're trading. So in this example, you'll see the butterfly of all the different option spreads will have the lowest risk profile and the highest return on that risk of any option spread. So what is a butterfly? So long butterfly spread, you can use calls or puts kind of to shape the direction. It's a combination of vertical debit spread and credit spread together. So you get the benefit of the debit spread, bigger profit potential versus the credit spread. The credit spread, though, you get that benefit of the additional credit received, which is selling time and volatility, which gives you an increase in your positive theta, but also reduces risk. So it's going to be a limited profit, limited risk trade strategy. It's going to have 3 striking points, and that's what makes the butterfly body. So the short body is where you're short and long wings. So the body right here is where your short strikes, and then your wings. So it's a neutral, kind of delta neutral, but I like to use it directionally. So it's just like in this example, a combination of a call debit spread here. So debit spread of 300 here. Then you add the credit spread to it. You bring in 200, having the same short strike here, the 1020, and you put it together. Boom, you reduce your risk here to $100. And if it goes out between, you're right here, this is the top of the 10. If it goes out right there, there's your max profit. and you're limited to your loss is only 100. So if it goes down, you limit to 100. Goes up, you limit to 100. If it goes out anywhere in between, you make a profit. So potentially these can be 10, 11, 12, 15 to 1 risk reward ratio. So basically, you could maybe put up $1 and make $10 or 15. So they're really fantastic in the right situation. Now the next really favorite one that I wanted to add is the is another favorite is what we call the counter diagonal spread. And this is kind of a medium to longer term directional option strategy to use. And what it is, it's basically what we call the vertical diagonal debit spread. So basically what you're doing is you're going to be doing two different option series. So you're going to take the long option leg, you're going to be further out in time on the long leg and shorter and closer in on the short leg. You're doing this to take advantage of that accelerated theta decay and volatility collapse from the short duration option. So you're long dated, short to short dated. That's what makes it work. So the advantage is that short term, if let's say you have short term or weakness or strength, but your bias of the trade is that eventually it's going to go up or it's going to eventually go down, you can stay with the trade and kind of like a covered call, just keep amortizing down your long part of the trade and keep in the position until it turns in the direction you want. The great advantage here is that instead of doing a covered call where you're long shares and you could have a very high capital expense, instead of buying the shares, you're buying the long dated option. So the trade takes advantage of, again, that accelerated time decay of that front short dated option. It's going to have a faster rate of decay than the back long dated, plus any implied volatility, positive skew, what we call that. And then another big advantage is there's the additional vertical spread component that adds a directional component for greater probability. So this is a way to buy options at a discount, and it's always done for a debit cost as well. So a really good kind of a profile is to think of it, if you think of a debit spread or something, they're in the same option series. So it looked like something like this. So your same option series. So you might be, let's say here, long, let's say you did this on a May monthly, okay? I can't write very well. So say this is all in the same series, May monthly. The difference here is that if you did this, you'd be going out, and instead of buying the same option series, you'd be here, let's say you're long the June call here, and then you're short the May call here. So it looks like a kind of a debit spread, but you're in different durations. So this is going to get the accelerated theta decay out of it. So this is one of my favorite. We do lots of calendar diagonals, either puts or calls. Great strategy. So, basically, more and more sophisticated investors and traders are learning how to use options. And options are a great way to protect your portfolio risk, great way to speculate, great way to make revenue, generate income. So today, I wanted to give you kind of the basics, kind of the overall summary or basics of, options to get you started trading options kind of in what I call a demo mode. But if you'd like to learn even more, I've got a really nice package here set up for everybody here today if you'd like to get in on it. And so this is my Get Started Trade Options today. This is a course that I did on just option trading. It's kind of for more comprehensive starting out course on the basics of options. So you're going to get this course broken down in 30-minute modules, the training manual of the course, plus you're going to get 5 other enrollment bonuses if you sign up today, and it's only only $97 actually. So here's the copy of the link here. So you should be able to just click on this link, and it'll pull up a payment link here to use for either PayPal or whatever credit card you want, and this will get you into it. But not only are you going to get the course and all that, but you're going to get some other enrollment bonuses. So it's paracycletrading.com/options if you want to do it that way, or cut and paste, copy and paste that link in. So it's $97. This course is yours forever. Now the extra benefits and bonuses I'm going to give you, this is a big one is that you're going to get a 1-month trial membership to my trading club. And this is a 30-day trial membership. Now you can start this whenever you want. So if you want to start this a week from now, 2 weeks, or what, a month, you can start it then. Just let us know. And the value of this, if you continue on, which I hope you do, then it's $97 a month. Or you can do an annual membership to cut it down and make it cheaper. So that's one of the bonuses that you're going to get from this package, which is $97. Plus, we'll do a follow-up live Q&A. We'll send you a link to that. This will be a week or 2 weeks, so that you'll get that. And then I'm going to give you my other kind of option guide. This is on the Greeks. So it's an option guide on Greeks, delta, theta, gamma, vega, that kind of more components of the option Greeks, how those work. So you'll get that. And then you're going to get that. That's videos and another trading manual handout on that. And then I'm going to give you what I call my complete option strategy manifesto. This is another 15 different option strategies, construction, when to use. So you'll get that. And then my Greek power tool guide, which is a printout you can put on your desktop of the Greek, so you can always refer to it. You know, if you're stuck thinking, oh, okay, I forgot what gamma is, etc. So this will be a printout that you can put on your desktop to grab to for access. So all this here for $97, but the main thing is the course, and it's a really good, really comprehensive, good beginners kind of introductory course. So you'll get the introductory option course, get you started trading options today. So this comes with the PowerPoint training manual of the course and the videos, comprehensive, easy to understand option trading, perfect introductory course if you're just starting out as a trader or investor and want to get into options. So it's going to go through the benefits of options versus stocks, you know, what you need to know before you start trading options, about option platforms, etc. Know the option basics, what, you know, puts versus calls, how option expiration works. It goes into 2 different kind of more beginning kind of option strategies, the covered call, and then a covered call with a protective put or a covered, you know, put protection kind of strategy. So really great strategy there. And then a good amount of resources also added to it. So you're going to get that 30-day trial membership to the club. And this will give you access to my virtual trading room. I'm in there every day, each and every day from 9:30 to 10:30 Eastern, Monday through Friday. So it gives you good access to come in, ask questions on anything that you're trading or whatever we're looking at. We'll go over that in the room. Any problems you have on a trade, come in and ask questions. I'll be there to help you. Then I do a daily market video newsletter every day after the close to give you an update on, you know, my view of where the markets are headed, what's going on with the markets, what's making them move up or down, and any trade ideas or things that we've done. That'll be also in the review. Then these are archived, and we do every Tuesday, we do a weekly Q&A live and recorded, so you'll have access to that for the next 30 days. I have a Trader's Education Vault, free education material, and then you'll get a discount on anything on our website, Power Cycle Trading, 60% off on any courses or software. So if you go here to Power Cycle Trading and you want to buy any trading software, just click on that, and anything that you see here, whatever the price is, let's say my scanner, the price is $397. If you buy that and you're a member, you're going to get a discount off of that $397. You just put in your member promo code here, and you'll get this at a 60% price off, discount off that. So any of my indicators, you know, these are all 60% off, or any of my other trading courses here, you get the course discount. So, you know, a lot of great benefits there. So got a lot of different option courses. That's my kind of specialty. And so anything on here that you're interested in, you know, earnings, selling options, butterflies, I've got pretty much everything here. I'll just kind of go through all the different courses. So here's what I'll be doing this weekend. This is a course that's called which option strategy to use for the best results. So this will be coming up. I'm actually going to do this Saturday. So the last time I did this was back in October a year ago. So that'll be coming up. If you wanted to buy that, you know, that course is going for $597. You get a discount off of that. And then, you know, you can, here, I'll show you the other course. I've got every option kind of course that you can, you know, basically any kind of option strategy that you do, I've got it covered in courses. So here's a breakout weekly options course using futures. Here's a Insider's Technical Trading Profits course. This is selling options for income, profits, and revenue and hedging. option income spread trading course using the calendar diagonals, earnings game plan courses and using basically earnings type of trade setups using what we call double calendar. Here's a butterfly course just did in April. So very extensive, great courses there for you to get discounts on. And that's pretty much it. So just a little feedback. This is the best service ever. Been enjoying daily sessions and making money to increase my retirement account. Seriously consider joining Larry for a truly rewarding educational experience that has real benefits, David. So you'll get bonus 2, my live follow-up support Q&A, and then don't forget 30-day trial membership. Start that whenever you want. You don't have to start it right away. You'll get my how the pros use the Greeks. So this is a 60-page option guide with videos on the Greeks and market maker secret, standard deviation, delta, price probability. And then my 15 option strategy guide. So it goes through, okay, what is a back ratio spread? When should that be used? What is a long straddle or strangle? So you get all of that. And then my option trading Greeks guide. So this will be a printout you put on your desktop. So a lot of great stuff there. Here's the link. I sure hope you will join up, and I look forward to working with everybody here in the future.
Thank you very much. All right. Well, thanks again to Anna and Investor Expo for having me here today to be able to present to you. I have about 45 minutes, so I'm going to go ahead and get started here. Normally, I would go through and kind of see where everybody's from and those kinds of things, but we do have a limited amount of time here today, and I do have a few things that I want to cover with you, and then I want to be able to go through some real-time chart examples with you. So with all that being said, I'm going to go ahead and get started. Today's presentation is titled Market Maker Levels, the Secret Trading Levels of a Veteran Floor Trader. Now, I don't really like these kind of marketing gimmicky secret inside, those kinds of things, but this really actually has a story behind why I have titled this presentation like this. And the story basically goes like this. I had the good fortune of being mentored by a veteran floor trader, somebody who traded on the floor of the S&P pits for north of 30 years. And as we began to trade together electronically, right? I was not on the floor, but when they made that transition from the floor to electronic trading, I had the good fortune of being able to spend some time with this person, and he had these levels that he worked off of every day. And as we were kind of getting into trading with one another, he would tell me about where these levels were located, but never really tell me exactly how he derived these levels. And what I was finding out is these levels were really, really good, right? That these levels were, they performed extremely well. And so it was kind of this joke. So as we would meet up together, and I would say, so tell me where these secret levels are today. And he would laugh, and we put these on my charts, and we'd kind of trade off of them. And that's kind of how we got to the point where we talked about these being secret levels. So again, kind of a gimmicky little marketing ploy here, kind of name, but at the end of the day, there was a real story behind why I call them secret levels. All right, so let's get started here. So the problem I see most frequently running a trade room for 11 years, and by the way, we're coming up in October, we'll have run this trade room for 12 years. The problem that I see most frequently here is that one or two good trades or days are often wiped out by a single bad trade or trading day, right? And I know that there's a lot of people that have had that same type of frustration, right? You have small winning trade, small winning trade, small winning trade, big losing trade that kind of wipes out the entirety of all of your profits for, sometimes it's on a single day, sometimes it's consecutive days that get wiped out by a single losing day or losing trade. And the reason for this is the risk reward ratio is out of line. In other words, traders will cut the winning trades short and let the losing trades run, right? Because that's kind of what happens. A lot of traders that I talk to kind of go through this process of saying, okay, well, I got into this trade. I like the way it's working. I'm going to take one off at X number of ticks, and I'm going to let the other one run, right? And so what in essence, you're doing when you do something like that is you are cutting those winning trades short. Because when I turn around and ask people, and I go through there's a whole nother presentation around this particular topic specifically, but when I ask people about, do they take off losing trades? Do they scale out of your losing trades? And most always the answer is no. So they'll let those losing trades run all the way to completion, and you will cut, not you specifically, but the retail traders that I talk to will let those losing trades run and cut those winning trades short. So what I'm going to show you today is how to change the paradigm by increasing your reward to risk ratio by up to 300% using a few simple tools. These tools we're going to talk about today is your reward to risk ratio that the reward to risk ratio tools are going to be these market maker levels. So you are in the right place today. If you're an active trader who is looking for a proven way to increase your reward to risk ratio, you are tired of seeing several days worth of profits erased by one bad trade or a bad trading day, and you are interested in learning more about these levels that were used by a veteran floor trader in his everyday trading. All right, so quick introduction again. My name is Jason Love. I'm the founder and lead trader here of the Oil Trading Group. That's me back in 1988. Yes, I'm getting old. This is me back in 1988, graduating from the U.S. Navy boot camp. I am a combat veteran of Operation Desert Storm, and I also held a top secret security clearance. This is me a few short 30 years later, actually longer than that at this point. I attended school and took an entry-level job in a travel call center. I became the VP of that same call center almost 11 years later. I was laid off after 9/11. As you know, you will remember the travel industry took a pretty significant hit right after 9/11. And again, we said we just celebrated in October of last year the 11th year as a trade room moderator and educator. We're coming up on our 12th year. Now, getting here hasn't been easy. In fact, it has been hard. I've spent over $30,000 purchasing training programs and trading education that didn't solve the one recurring issue, which was consistency in my trading, and I almost quit trading entirely. It wasn't until I was able to change my trading paradigm and learn how to cut the losing trades short and let the winning trades run that I found consistency in my trading. Now, before we get started here, of course, there's the government required disclaimers. The Commodities Futures Trading Commission wants you to know that futures trading and options trading has large potential rewards, but also large potential risk. You must be aware of the risk and be willing to accept them in order to invest in the futures market. You should seek appropriate advice from your broker or licensed investment advisor before taking any action. Trade with OTG does not hold itself out as a commodity trading advisor. And so given this representation, all material provided by us to you here today is for educational purposes only and should not be considered specific investment advice. And again, hypothetical or simulated performance results have certain limitations, unlike actual performance record. All right. So when we all come to these things, and I participate and attend webinars like this one, when we come into these things, the one question we always have in our mind is what am I going to see today, and does it actually work? And so this is on the Top Step Trader website from a couple of years ago. And if you're not familiar with who Top Step Trader is a proprietary funding firm, right? And so if you can pass their trading criteria and show that you can trade, then they will give you a funded trading account. There are windows of time that you can do that in, and what you see here on the screen is that a screenshot from their website a few years ago. Again, this was the fastest number of days to funded trader was 15, and that was me, right? And so I created a webinar that's one of the more popular webinars that I have on my YouTube channel. It says how I passed the Top Step Trader $50,000 trading combine in 15 trading days. So I made an entire webinar presentation. It's about an hour long. And if you go to the YouTube channel, Trade with OTG YouTube channel, you'll find that webinar on there as well. So again, to answer the question, what I'm going to show you today, does it actually work? And that's what I'm going to endeavor to show you here. So again, I have taken a number of these trading evaluations. And so before we go into these numbers here that you see on the screen, what I want you to understand is that these trading evaluation companies have one thing that they are interested in doing first. And that thing that they're interested in doing first is to minimize their risk, right? So when you go take one of these evaluations, what you're really being evaluated on is how well you can control your risk. It's not how much profit you can make, but how well are you mitigating and controlling your risk? And so the way that you go about doing that is a reward to risk ratio that is greater than 2 to 1, 1 to 1, 2 to 1, etc. Right? So again, we all intellectually understand that the objective is to win more when you win than lose when you lose. And so what I want you to see here, or what I want you to focus in on, is the average winning trade here, right? So if you look at the average winning trade during these different evaluations, all were passing evaluations, and I would do these evaluations in my trade room, right, in front of a live trading audience, that the average winning trade was $421, while the average losing trade was $119. That's a 3.5 to 1 reward to risk ratio, right? The average win rate during that span was 45%. So if I said to you, hey, over the course of X period of time, right, if you take this first one up here, this 150,000, if I said to you that you're going to have a winning percentage of 41%, right, that you're going to win only 41% of time, which means you're going to lose or break even 59% of the time, you would tell me not interested. If I told you during that same window, that same 10-day window, that you're going to make $41,000 in your trading evaluation, you would say, sign me up. And they're both the same systems, right? And so the point is that we get fixated a lot of times on winning percentage, right? Because that's a psychological, mental type hurdle. We all want to win a lot, right? But the win percentage is not what's really important. The reward to risk ratio is important. So if you are cutting your losing trades short, right, at $119 and letting your winning trades run, $421 at 3.5 to 1 reward to risk ratio, you're going to have a lot of small losing trades. And then when you get into that big winning trade, it's going to go a long way and it's going to make up for the losing trades. Again, that's a paradigm shift from what a lot of traders go through. All right. So just to continue on, this was in October of 2020. This is a letter that you receive, a funding letter that you would receive from Top Step Traders. Says, congratulations on passing the trading combine and reaching the funded level. Now, they will then split you off into two different paths. One is they'll put you in a pro account, which is still a simulated environment where you can earn real money in this simulated environment, or you can go directly to the funded account. Now, this is a topic for another presentation, but what I would tell you, if you are interested in something like a Top Step Trader, you always want to go with the pro account. There's a number of benefits for doing that. We're not going to talk about all those benefits at the moment here, but you would always want to go into this pro account. Once you go into that pro account, they then say, once you pass this, step one, and you go into this pro account and you can make $5,000, they're going to move $5,000 into a live trading account for you, right? So you're going to be in a simulated environment where they are then going to move that. If you make $5,000, they're going to move that over into a live account for you, or you could literally cash out at that moment if you were so inclined, right? So again, this is just kind of reiterating that. It says here, once the simulated balance reaches $5,000, they will start that premium funded account for you. And this letter here lets you know that congratulations, you earned that premium funded account. We're thrilled that you have reached that significant milestone on your trading journey. And again, we will transfer your pro account balance to your premium funded account up to $5,000. Now, again, I show you that. That's one of many of these that we have done in front of a live trading audience. Now, again, going back to, does this actually work? This is evidence from a third party that is looking to mitigate their risk and maximize their reward, that they have agreed that you've been able to take this and do those things. Now, it wasn't just Top Step Trader. There are other of these types of entities in the marketplace. This one happens to be Earn to Trade. Earn to Trade approached me several years ago and said, hey, we understand that you do these live trading evaluations, and we would like to be able to talk to your audience about that. And I said, sure, that's fine. But in order to do that, I need to go through your program and make sure that everything is legitimate. And so they said, fine. And we went through the Earn to Trade program, what they call a gauntlet. And I created a webinar on this that was titled a $5,000 deposit from start to a $5,000 deposit, my experience with the proprietary trading firm. Now, this also is the screenshot of where they deposited that directly into the bank account. You'll be able to see that, right? There is the earn to trade deposit for $5,000, and we created a webinar around that as well. Now, it's not just me, right? It's a lot of times when you come onto these things, you go, well, okay, that's great that you can do it, but could I do it? So this was an email that we received from Stephen G, who was in for a 4-day free trial. And during that free trial, he said, by the way, I passed the first step in phase 1 with Top Step, following your trading methodology during my free trial over the past 4 days. If that wasn't worth every penny, I don't know what is. Ultimately, he did join, of course, and that was his screenshot that he sent to me also in an email. So not only did it work for me, but it worked for someone who was in on a free trial, just kind of watching over our shoulder as he took these trades in his Top Step Trader trading account. Now, I'm not just cherry picking these. I have a YouTube channel with literally 400 plus videos recorded from the day trading chat room. Now, we have rolled out a new program recently, so I haven't updated the YouTube channel in a couple of months, but in the end, we have right now on our YouTube channel, we have over 400 videos that were taken during our live day trading chat room, where you'll be able to see the market maker levels that I'm going to show you here today in action in a live trading environment. All right, so the market maker level trading program that we do is all about the process, right? So we have a kind of a 5-step process that we go through. First of all, we talk about the market context. The market is always telling a story, right? So our job is to figure out what the story for the day is. Right now, we know the markets have been very volatile. Yesterday, there was a big sell-off. And so we understand with all the geopolitical things that are going on in the world that the existing context or story is that the market is bearish, right? And so market structure, once you have the context of the story, then that's where the market maker levels come in. That gives you the structure that we are looking for inside the story. So the way I kind of look at it is the story is the book, and the market maker levels are the structure. Those are the chapters inside the book, right? So then we talk about, once you have the structure, we talk about what your trade plan is going to be today. What are your strategies going to be? Then we have our trade tactics. That's where you actually execute your positions. And then from there, we talk about what I consider to be the most important component to all of this, which is risk management, right? We consider that to be the most important process here, which is your risk management. All right, so let's talk about what are the market maker levels? Well, the market is continuously telling a story. The story provides the context for the daily trading session. We just talked about that, right? The market maker levels are the structure points inside the daily story. And once determined, these structure points are used as tactical areas to make trading decisions, entries, stops, and target locations, right? These are the points on your chart where you're going to make your tactical decisions. Now, why do these levels work? I get asked that a lot, right? Why do they actually work? Well, there's 2 approaches to this, right? You could say, well, I don't know how my car works. I get in, I push the button, I hit my key fob, the engine turns on, and it works. That's all I really care about. That's all I really want to know. But there are others of you that are going to actually want to know why these actually work. And so what I'm going to show you here is a profile chart to kind of explain a little bit about the rotations that go on in the market. So as you know, statistics will show that the market will be non-trending greater than 80% of the time. So as you know, the market will rally, right? So from this low, it will rally and then pull back, and then it will rally and it will pull back, and it will rally and it will pull back, right? These rotations, right, are what is the backbone for how these levels work. So in order to fully understand why the market rotates, you must understand the auction process and how the markets go about discovering what the fair prices are in any given day. And so when we talk about story, we talk about, we look at that profile. We look at profile quite a bit in here, right? Not the levels aren't based upon the profile, but we look at the profile to get the story, right? Remember this, the market moves from horizontal development to vertical development to horizontal development and so on. So if you're an aficionado of someone like Jim Dalton, right? He tells you that the market is in a continuous rotation. It rallies to find sellers, it sells to find buyers. And it's in those rotations where the market is always searching for buyers and sellers. That's the true function and nature of the market. So again, the sole purpose of the market is price discovery. The market will rotate within a range of prices until a variable changes that causes the market to rally to find sellers and sell off to find buyers. If you think about it in other markets, right? Like let's say your housing market. So if you've ever sold or bought a house before, and many of you have, you know that the way that they find value for the market is they take comparable prices, right? So they'll say your house is a 3-bedroom, 2-bath at 2,400 square feet. We're going to find similar houses like that in the market. Well, that one has a pool, so we're going to assign a little bit more value than this one. This one has a little bit bigger yard. We're going to assign a different value. But at the end of the day, they kind of normalize where the market is, right? They kind of normalize where the market is, and that's how you find the value. But in that same market, if they were to find the groundwater underneath this subdivision was making people sick and causing cancer, let's say, well, all of a sudden, the values in that market would go straight down. There would be something that changed to break that rotation, and the market would aggressively sell off until it found a place where the buyers could step in and say, this is now a value. I'm going to buy here because I have enough money now to fix whatever the groundwater issues are. And then we'll look to ride the market back up once we make that investment down at the bottom. And conversely, if they found a rich oil deposit, they developed some new technology similar to fracking where they could extract oil out of the ground that has otherwise been unobtainable. Well, all of a sudden, the value of those properties would go up until people would say, look, it's too expensive now, and then the price would begin to lower and buyers would then begin to step in for those sellers, right? And so that's the way the market works here in the futures market, right? You've got buyers and sellers coming in, and when an event changes, the market will sell off until you find a place where buyers are going to step in. And that's essentially what you're looking at when you start looking at these particular levels, right? So again, these rotations create a set of measurements that are based upon time and price cycles from previous trading sessions. These measurements are then projected forward and become the structure points for the day's trading session. So if you look here, here's a good example, and we're going to do some real live chart examples here in just a moment. But this is a good screenshot here of how the market rotated around this, what we call our structure signal, sells off, pops up, right? Finds a little support here initially, and then sells off down to this level, rallies back up, rotates around the level, sells off, slips a little bit through, comes back up, rotates, sells, and finds support finally at the lowest RTH, regular trading hour, lower target, right? And so that's what these levels do. They are measuring price and time cycles from previous sessions and then get projected forward into the next day's trading session, which you are seeing here. Now I get asked this question quite a bit. What's the difference? Why wouldn't I just use floor trader pivots, right? Those were created by a floor trader, so I'll just use floor trader pivots instead of your market maker levels. And you can do that, but there's a couple of distinct differences here, and I'm going to explain what the differences are. The floor trader pivots are calculations based upon averages of high, low, and close, right? So the pivot point, kind of that center line, is the day's high plus the low plus the close divided by 3. Your R1 and R2 pivot points are prior day high and low, and your S1 and S2 are prior day highs, right? So again, these formulas have a variation all the way through the R1, R2, S1, S2, S3, etc. Now, these measurements are basic in nature and do not take into consideration changes in market and price volatility or range expansion as it's occurring in real time. So if you've ever traded floor pivots, you know that on really extended trading days, you run out of levels, right? You've passed the S2, you've passed the S3, you passed the R2, you passed the R3, and you're kind of stuck now wondering, what do I do now that the market has expanded way beyond these levels? Well, these market maker levels not only take into consideration previous day's rotation, but they can also adjust in real time to account for these expanding ranges that are going on in the market. So again, the market maker level calculations are based upon measurements which derive from time and price movement. And because of the time calculation involved, these levels evolve in real time to account for the changes in rotation and price discovery. There are three measurements that we look at: ETH, which stands for extended trading hours; RTH, which are regular trading hours, and those are levels that form up after the pit open. And then finally, you have the intraday trading session levels that will then develop in real time. So I'm going to show you a chart from yesterday where the market was overly extended, right? And so there might have been an opportunity to use those intraday trading levels. And so with that being said, let's go ahead and take a look at some examples here. All right, so here is the chart from yesterday's NQ, right? So this is yesterday's NQ. You'll see that this is the 18th. Today is the 19th, right? And so here is yesterday's NQ. So the market opens up and you have your ETH structure points, right? So the ETH structure points form up after the open, or after the pit close actually, and go into the next day's open. Market opens up, sells off, begins to hit. This, by the way, this mustard line is the ETH session open price. It's the price where it opened. Rotates around that. And then this is a 3-minute chart. And so you spend about 30, 45 minutes just rotational around this level. Makes a new low, pops right back up again into that level, makes a new low, comes back and checks it one more time, and then to the next level, to the next level, to the next level where it stopped. That was the low on the day, rallies and pulls back down through it here, right? And so again, that's just an example of how these levels work. So if you continue this on, right, you'll be able to see that this market then continued all the way down, right, into the structure point down below, right? And so I'm going to show you just kind of how you might play these levels. In fact, let's do that here right now. So we're going to come back here. All right. And let's say that you were trading right here. Now, I'm not going to recommend that what I'm about to show you, I'm not going to recommend that you do. But for the sake of this example, I'm just going to get in every time, right? We're just going to show what it looks like if you would get in every time. So I'm going to turn on, we have what we call a zone of influence on these levels. And the zone of influence, just to explain what that means, is, as you know, support and resistance is less about to the tick precision and more about zones of influence. Let me say it like this. If you were to wait every time for a level to be touched, then you're going to participate in the market every time that trade or that level fails. If you don't, so let me say this here. Let me do this here real quick. I got to get this to make sure this is a tick count needs to be 80. Hang on real quick. Let's see, we'll try this again here. All right, so let's hit apply. It's okay, there we go, got it. Okay, so let me say it like this. If you waited to participate every time the level is touched, every time that level gets touched and it fails, you'll participate in every loser, but you won't necessarily participate in every winner, right? And so support and resistance is more about zones of influence than it is to the tick precision. Let me give you a couple of examples here, okay? So let's say that you were going to that we were looking for the market to get, well, we'll just do it like this. Let's say that you were going to participate here, right? And let's see, we're going to go to, we'll go to ruler, right? And let's say that you were going to wait to get long here, okay? You're going to wait to get long down to this level. And you're going to put your stop just below this zone of influence. You would have taken a 41 tick stop, okay? That's a 41 tick stop that you would have taken there. Market breaks down, sells off, comes back, and you said, I'm going to take this I'm going to take this short because I'm not advocating you do this. I'm just, every time it touches, I'm just going to show you an example. Okay. Market gets short, you get stopped out here, comes down to the low, breaks back up into this level, and then gives you an opportunity here for 154 ticks, right? So 154 ticks divided by 4 is 38.5 points. But let's say, for example, you were holding on for this level down here. Well, you're back here to break even. Take out a break even, you get in it again. This time it comes down to this low, and that's 289 ticks. And again, I'm not advocating you do it this way. I'm just showing you examples. That's 72 points. Market rallies back up here, right? Rallies back up, and you may not have been stopped out. If you had your stop at break even, you wouldn't have been stopped out here. And you're going to ride it. Let's say your target is this level and the structure point down below, right? That's your structure point. That's your target down below, right? So the market comes down, gets to within that zone of influence again, and continues to push through and eventually hits that, what would have been your target, okay? So that is 661 ticks, which is 165 points. Now, you've taken one loser for 41 ticks, and you've taken one winner for 661 ticks, right? 661 divided by 41 is a 16-to-1 reward to risk ratio. That's perfect, right? That we'd all take a 16-to-1 reward to risk ratio, right? We would all take that every day of the week and twice on Sunday, right? And so that's kind of how these structure points would work here on the NQ on a very aggressively moving day like yesterday, right? So again, target there. Now you are clearly in a bearish trend here on this day, right? Lower highs and lower lows all the way down. And so let's say you tried, the market takes your target, it pulls back, you try to get in up here, it doesn't hit your level, and you continue to look, comes down. If you did get in here at this zone of influence, great, you would have hit the target or the next level down below. All right, so let's do this. Let's take a look at today's structure points, and we're going to start here with your RTH session levels. Now I'm going to turn on those zone of influences here again, and I'm going to spend some time on the NQ, and then we're going to look at some other markets. But I happen to really like the NQ. I started this whole process when I began trading in the chat room, trading oil, right? And I loved the way that the oil market would move, and so that kind of the NQ really is like the good old days on the CL. All right, so let's say that you started here, right? You started here at this point. Let's move this down to a 2-minute chart because that's what I like to do on the RTH session. Start here on this 2-minute chart. Market opens up, right? Pulls into this level, and let's say that you looked to get short on the initial touch into this level, right? Well, this market went down 135 ticks. Well, 135 ticks divided by 4 is 34 points. That was enough for you to be able to get safe. Market opens up, closes right on top, and let's say you just got long, right? These are really choppy day. That's 195 ticks, enough to get safe on. Market pops down through, gets up here, right? And let's say you took the short here this time, you would have been stopped out, right? And let's say you come down here. So, but it eventually comes all the way down to this level, breaks down through. Let's say that you were looking to get long on the break of this level here, right? Which is something that I like to do on the break of the level here. I'll go this direction. You could really do it up here. Let's say you did it up here on the break of this, right? You're clearly above on the break of that. And you are in all the way up to that level. That's 368 ticks divided by 4. That's 92 points. Okay, so you had 2 break-even trades and a losing trade, 1 winning trade. 2 break-even, 1 lose, 1 win. That's 4 trades. You won 1, and now you're at a 25% win rate, but you're at 92 points with a 40-point stop or 40-tick stop, right? 40-tick stop is 10 points. That's a 9-to-1 reward to risk ratio. You can do a lot of things wrong and still be okay with a 9-to-1 reward to risk ratio, right? And so this market has been choppy today, right? In fact, that's what we did in our trade room today, right? We kind of gave up because the market was really choppy in these areas, right? And you could play these levels, and again, if it depends on how you're looking at the world, but again, this is just a retracement here. So if you're looking for shorts today, then you're playing these levels and you may have a tough day, but all it takes is one, get it right and ride it to that level and you're okay, right? And that's kind of what we look at on a daily basis here. So we're going to take a look here at the ES. We're going to turn off the overnight structure points and turn on the day structure points here. And we actually took this trade in the room today, this one right here, where we were looking to get short, believing that the market was going to be short today. We ended up getting in at the RTH mid. The market sells off for 84 ticks, which on the ES is 21 ES points. And I think we got trail stopped back on the way back up here. But you'll notice one of the things that we talked about, if the market cannot make it to the level below, then it's going to get back to the level above. Same thing here, level couldn't get quite to the level above, made it to the level below, rotated, and then up to the level above it, rotational, couldn't get through to the level above, came back down, and you are in a nice little choppy range. And I say nice little choppy range. There is still opportunity here. Even if you're getting stopped out, taking every single trade, which I don't advocate, even if you're getting chopped up around here, right? The distance between these levels here, when you do get that one that works and you're holding on, that's 126 ticks divided by 4. That's 31 points. I have a 3-point stop. You could be wrong 10 times and still be okay, right? So on a choppy day like today, even when you're getting chopped around and beat up and it's just rotational sideways, even on those days, you hold from level to level, right? You could get chopped up all day right in here and take a 10-point winner. Or sorry, that's a 31-point winner. You could get chopped up, go try to get long and short right in here. Finally catch the short for a 31-point winner. You could have a lot of losing trades and still be okay with a 10-to-1 reward to risk ratio, right? And that, again, just kind of playing itself out here again today. So these will bounce between these levels, right? And you can find opportunity. Now, I'm just showing you if you took every single one of these trades right out of the box and didn't do anything else, which I don't advocate you doing. We give you filters like delta and volume weighted average price and context in the market and things of that nature to kind of help you determine what the opportunity should look like or could look like. But my point is that if you just play the levels by themselves, you will be in good shape because these levels are extremely effective. Let's go back to the previous day here, right? And there's no better example of how these levels work. And we took this one in front of a live trading audience yesterday, right? Market opens up, tags into the structure, that RTH signal, that's 98 ticks. If you wrote it to that level, if you wrote it down to this level, that's 195 ticks. 195 ticks divided by 4 is 50 points. Your stop is 3 points. Even if you're wrong today and you made a 50-point trade yesterday, you're still okay, right? You could be wrong a lot with 50 points. Now, you'll notice that we extended way beyond these day levels here, right? So what I would do then is I would be looking at the overnight structure points and look what happens, right? This is overnight structure points, and this market gave you structure all the way down through your levels. And watch this. I don't know how this is going to work out, but it looks like it's going to try to come all the way down. All right, didn't quite get in all the way down into that level, but you'll see that again, they rode these levels like stairs on a ladder. So when you're in and understand the context of the story that market's trying to tell you, you're able to then get in, you can maximize your reward while minimizing your risk on these opportunities. All right, we'll do one more here. We'll take a look at the CL really quickly. So this is, I think this is today, right? Yeah, this is today's CL. Market opens up below your level, comes back, tests, right? So let's say you tried to get short here initially, you get stopped out for 12 ticks. That's what I like on the CL, right? And the market comes down and tests the top of that zone of influence. And that's really it today, right? The market just continued to rally for the balance of the day. So let's say you took one stop down here, one stop up here rather. I tried to get short, you turn around, you go, okay, I got stopped out, I'm going to play the other side here. And there is 208 ticks on the CL. If you went to that level, rallied all the way to this level here. There's 421 total ticks, and you're all the way up to this high is 583 ticks on a trending type day today, right? And so again, let's say that you missed this first trade here and you waited for it to come back here. So you took, let's say you took 2 stops, right? You tried to get short here, you got stopped out. It rallies, you tried to get short here, you get stopped out. Now you've taken 2 trades, 2 stops, right? Comes here and you said, I want to get long. You've taken 3 stops, you're down 36 ticks. Comes back here, and again, I'm not advocating you do it like this. I'm just showing you every time. If you just said, look, I'm going to take every time it comes down the road, then you've got this opportunity from 105.90 up to 108.03. So 108.03 minus 105.9, that's 213 ticks. And you took, let's say you took 3 trades, 4 trades lost at 48 ticks. You would have 1 winning trade, 4 losing trades, a 25% win rate, but your 213 ticks and your 4 divided by your 4 stops is a 4.5 to 1 reward to risk ratio. You let your winning trades run and you're cutting your losing trades short. Your win percentage is low, but again, you're getting out when it's not working. You're just cutting that loser short, throwing it back. It's like, you know, when in one of those fishing competitions, right? Where you throw it out there and you pick up a fish and it's kind of below weight, you throw it right back, or it's not big enough or whatever, and you throw it right back. And that is what's important in my opinion, and was the important in the estimation of the floor trader that I worked with, and is also what's important to these funding companies, is that you're getting out of losing trades very quickly. Get out, get out, get out, find your winner, understand where you think the market's going based on the context, the story the market's trying to tell, and what it is that you're doing in terms of these structure points, right? Now, I'm not a gold trader, and I don't even think I'm on the right month for gold here. Yeah, I guess I am. But here's the gold chart, right? Same thing. Market opens up, right? Just below this structure point, stops you out, gets back in here, right? Again, I'm not advocating you do this, but look at the look at the context of story, right? So you're probably not getting short here. You probably are looking to get long, right? With the structure to the target, right? Boom, 93 gold ticks. Market pulls back, can't get to the level below, rallies up again to the level above, and then what does it do here for all the way up to this next level, right? Which is 93 ticks, stops, that's the high, comes right back down to the zone of influence and your RTH target, right? And then that's where it kind of settled out on the day. We can look at the YM again here. We'll take a look at the YM as well, right? So again, I'm not a YM trader, but again, the market rallies up through, breaks through, you take a stop, and what does it do? It comes down, couldn't get to the level above, comes down to this level here and pulls back all the way down for 229 YM ticks. And let's say that you tried to get short or whatever here, and you get chopped around a little bit, but what does it do? We know if it can't get down here, that it's likely to come back up here. 200, again, same thing. Market comes here. What does it do? Couldn't get to the level above, comes down to the level below. And that just cycle just repeats itself in the markets every day, all day, in all of these futures markets. That's what happens with these levels, right? These levels are gold. You add now, you start adding a filter to it. Like, what is the story the market's trying to tell you? What is the context, right? Is it long? Is it short? Right? One of the things that we like to look at is gaps. So is the market gapped open higher or lower? Well, if it's gapped open lower and it's not making a play to close that gap, then you know you probably got a bearish idea on the day. If 100% of the overnight inventory is below settlement and the market doesn't try to get into settlement, then you know you got a bearish market. Same thing would be on the other side for longs. If the market is long, right, and 100% of the overnight inventory is above settlement, these are filters you start adding. Where is VWAP, right? The volume weighted average price is extremely well adhered to on the NQ and the ES, right? So those markets really observe and respect the volume weighted average price. So that's a good filter when you're trading the ES and the NQ. So I've got about 4 minutes left here, and I'm going to throw, let's do this. I want to move this back here. And so here's what I'm going to do today for you. Let me recap first. We have a 5-step process that we go through here every day. We talk about what's the market context, what's the story the market's trying to tell you. We give you the structure points, the market maker levels. We talk about strategies, your trade plan, what are your ideas for the day. Then you have your execution tactics. And then finally, once you're in that trade, are you getting out quickly and are you holding on for the winning trades, right? And that's the way that we look at this on a day in and day out basis. So what I'm going to offer you here today is something very simple and very easy, will cost you nothing to come into our trade room and watch us for a free trial, right? You get to see this for yourself. So I'm throwing the link into the main chat window. Whoops, I think I just sent that to the organizers and panelists. I need to send it to everyone. So I'm going to throw this link in here for you again. And you could come in and register for a free trial, right? You'll be able to come and do that and register for a free trial. Take a look at our trade room and come in and spend a few minutes with us. Let's see here. Yeah, it is a lot of ifs, but again, it's hard in this environment here, right? It's hard in this environment to say you're going to do this, that, and the other thing. It's a 45-minute presentation, which is why I'm going to give you a free trial to come in and you can see us execute it live in person on a day in and day out basis. Yeah, at the yes, if you go to the YouTube channel, and we started this presentation here today by showing you the track record for all of the different things that we went through with the, I'm going to throw this here, this YouTube channel in here for you, right? You can take a look at this YouTube channel. These are trades that we've taken in front of a live audience. There are nearly 400 videos. It looks like this, right? This is what that channel is going to look like, and I got about 1 minute left. Right, but here you go. And again, I have not updated this. We were going through a beta test on another program, so I haven't updated in a few months. That's why I'm giving you a free trial to come in and take a look. But here it is. There's 116.75 NQ trade. There is the 5-day winning streak that we had. There's an NQ trade. These are just kind of daily trades. And like I said, there's nearly 400 of these on the YouTube channel, going back for years and years and years, right? So you'll be able to come in and get a sense for what we're doing there. And then you got an opportunity to take a free trial where you'll be able to come in and see these things live and in person for yourself. I'm going long at, I'm going short at, flags appear on the screen, P&L at the top of the page. You'll be able to see all of those things and you'll be able to come in and participate, and you'll see it, like I said, live and in person. You'll be able to see all of that as we go through it. So with that being said, I've got about 14 seconds left. You guys have an awesome rest of your day, and Anna, over to you.
In the meantime, what's up, everybody? Great to be here with you. And of course, Jason's presentation was great. And if he's listening, thanks for your service, brother. I appreciate it. But in the meantime, we're talking about day trading today, and we call it our day trader's dream. And I've been a trader for quite a while, which you'll see shortly. The trading nightmares, the dream is alive, is what we say, because again, to me, this is one of the greatest methods, which has no overnight risk, which has, strictly trades based on the original pit hours and all the things that make sense to a guy who's been trading like myself for a great number of years. But as you've probably seen in every presentation, you've got the disclaimer, and of course we make the disclaimer as well because that is by law. And again, there's past results are not indicative or guaranteeing future performance. So again, remember that there is nothing for nothing, and there's no guarantees of what's going to happen tomorrow. But I always want to make sure, and of course, I am Todd Bubba Horwitz, if you don't know me, and I've been trading professionally for 44 years. Okay, 34 on the floor, and the last 10 on the screen, and as an educator as well. I didn't know, I used to educate my own traders and my own clerks because I had my own prop traders that would work for me. Okay, I do use every one of my own services. So if I'm giving you a trade, I'm right there next to you. And I was one of the original market makers in the SPX back in 1982. So that's just a little brief introduction of who I am. And again, I always want to make sure everybody understands this. Okay, there are drawdowns. Okay, they happen. There's not. Look, as I said, 44 years I've been doing this. I have not gone a long period of time without some sort of a drawdown. But really, drawdowns turn out to be an opportunity if what you're doing is a good method. And that's what you have to understand about what the drawdown is. But again, it never feels good when they're happening, and nobody knows how far they can go. It's like when you were looking at the chart with Jason just a few minutes ago, markets consolidate X amount of time. They're discovering price. Everything is going on. But at the end of the day, you should be going lower left, upper right, but there are potholes along the way. Anybody who tells you that they hit 96% or whatever is lying. It's that simple. Okay. Now, again, can you really remove your emotions? And the emotional trading is really the biggest flaw in every trader. I trade live every single day with my members for an hour because we do a number of different things, and we trade 4-minute charts. And again, the lecture every day is always the same. Can you control your emotions long enough to make the right trade and do what you're supposed to do instead of not? And that's why we've become and developed these robotic systems, these algorithmic systems, because again, it takes you out of the equation. Because no matter what you say, all of us have an opinion at some point or another. And even if you don't consciously, subconsciously, that opinion is going to come into play when you look at the market. So we try to remove all that for you. And that is through our algorithmic day trading. Okay. And again, I use algorithms on swing trading, on day trading, on my hedging models. I use it everywhere. Why? Because A, it makes it simple. B, somebody else is doing it for me, so I don't have to deal with it. So I can go out and play golf. I can go out to my pool when I'm in my home in Vegas. I can go wherever I want because I know that the market is the algorithms that have been written are going to tell the executors that there's a trade to be made. Excuse me. I don't have to worry about it. It makes it very simple for me. But first, before we get farther into this, everybody always talks about market manipulation. Okay. And I go, okay, gold is manipulated, silver is manipulated. Look, there's only one true product that is truly manipulated, which is the fiat currency method, which is the dollar, the yen, all those, because those are being taken from through the central banks to create more money for them. So they deflate your currency. But the rest of the markets, every market, even the fiat currencies, have to go through price discovery. So manipulation is simply a product. If someone's trying to sell them because they want to manipulate the price lower, they're going to find buyers. The question is, where do they find the buyers? Because no trade can be made without the exchange of wealth. So remember that it doesn't matter if you think it's manipulated or not manipulated. It really does not matter. At the end of the day, there's got to be a buyer and a seller meet before price discovery takes place, which means before a trade takes place. And I love to tell the story. My grandmother, God bless her, loved to go to the racetrack, the harness horses. And I said, we tell her, Grandma, the horses are fixed. She said, well, maybe I'll bet on the crooked horse. Okay. In the meantime, we're talking about leverage trading because we're going to do this in the futures world. Okay. We're not doing this. We do it in all products, but this particular product, which is partnered with Capital Trading Group, is using leverage products or using futures, and it's either using micro futures or mini futures or combinations thereof. But you really have to understand what leverage is and how you're using it, because leverage is a great tool if you understand it, but it can be very dangerous if you don't. Okay, so we have to make sure that you understand when you're using margin to trade. And the beautiful thing about day trading is you get special margins for day trading. They are not the same as overnight margins. For example, and mini S&P during the day, during the trading hours, is $1,000 margin, and you're controlling, let's say, $250,000. Okay, versus overnight, that same trade, if you held it overnight, the margin is about $12,000. So you're getting, for very little money, you're controlling a lot of money. So you get a much higher return on your capital invested. And again, but you have to understand what you're doing, because if you're in a number of positions and your account's 25,000, you may be controlling $500,000 of securities at that time. Okay, and you have to understand that there are some swings. Now, when you're trend trading, which is what we're doing, and if you remember, the original trend trader was Richard Dennis, the Turtle Traders, if you've ever heard of them. Richard was a good friend of mine. We traded together on the CBOE in the 80s. And he said that he could make anybody a trader who could follow the rules. And we've taken trying to turn you into a trader and put it into a position where we're going to help and do it for you. Okay. So, but margin trading is using a little bit of money to control a lot, to have an opportunity to make lots of money, okay, with little risk, because you're going to be stopped out at some point. And we do use protective stops in these models, which are also designed by the algorithm that we're going to use. But if you understand trading, and if you've been trading for any length of time, okay, trading is a game. Okay, that's the facts. All right, it's a mathematical model. You know, if you ever looked at a chart, it is a series of geometric progressions. Okay, trading is a game very similar to poker, gin, backgammon, and bridge. Those are all games of skill. You won't win every time. You may be the best player in the game, but you're not always going to win. However, you're going to have the probability on your side, which is going to put you in a position to win over time. But it comes back down to the mental edge, the way that you play the game, okay? And we're playing to win, okay? We're not playing for any other reason but to win. You know, life comes down to two things. One of them is always money. I don't care what your other one is, but one of them is always money, and I don't care what you tell me. That is always a fact, because that's what it comes down to, money. So that's why you're here. You want to figure out ways to make more money, and that's what we're trying to help you with. Now, I say invest in yourself. What does that mean? Well, it means that it's time for you to really put your money to work in good programs that actually make sense to you and that work for you. Now, what I do is not going to work for everybody. And look, I want happy members. The bottom line is I want to have people to be happy. I want them to make money. I want them to have a good time doing so. I have a chat room for my members. They can hang out and talk all the time on the different products that we deal with. But you're investing in yourself, and we're going to use, as I said, we're going to use the futures market. And why are futures the best option for day trading? Well, if you've ever tried to trade day trade options, you'll know the answer to that. But futures are highly leveraged instruments, okay, which we talked about, right? So we're controlling, in theory, $250,000 for $1,000, okay? The markets are much more liquid than the equity or the option market, because these products were designed to be traded. Okay, these products were designed for you. The commissions and the execution costs are lower than in equities. Okay, futures markets are more fair and more efficient. All right, because they don't get involved with implied volatility. They don't get involved with all the outside noise and factors. You can short sell anytime you want. There's no ever restriction there. You get day trading margins, and one of the biggest things is the FINRA day trading rule. And if you've ever been stuck in that FINRA day trading rule, you know exactly what I'm talking about. It is a brutal position, because you only get 3 trades a week. Now, how are you going to do that if you're trying to day trade? Doesn't work out very well. Now, the benefits of auto trading, which what you're going to be doing is not necessarily auto trading here. You're going to be doing what we call letter of direction trading. Okay, but you have no emotion. You're not only are you minimizing them, there's none. You may be aggravated, okay, to trade, but at the end of the day, you're not making the execution, you're not making the exit. You're letting the model work for you to do its best job to help you make money. Okay, automated trade system minimize emotions throughout the trading process. It preserves your discipline, because you cannot make a mistake. Okay, it diversifies your trades. It avoids mechanical failures. If you've ever been stuck in a trade and been down, it's not a very comfortable position to be in. Okay, you can monitor your own positions, but you have somebody monitoring every position that is on until it is at completion. You never miss a trade, and there is no temptation to cherry pick a trade. Okay, and these are the things that we want you to understand, because in algo trading, okay, you have a very specific plan. Okay, we have rules. Okay, we've got stop set, and everything is automated. There's no human element of what we do. Okay, the entire process from the entry, okay, that is triggered, to the setting the stops, to moving the stops, to taking profit, to closing, are all automated. There's nothing to think about. There's no decision. There's no human playing in the game. So the day trader's dream is a system that trades during the original pit hours only. even though we no longer have trading pits, okay, we trade the pit hours only. And the reason for that is because, believe it or not, that is still where the volume sits in markets. Okay, that is still where volume exists. And if you look at the overnight trade and the futures, if you ever watch, there's really very little volume unless there's something crazy going on in the world. No trade can be entered until 8 a.m. Eastern or after 3 p.m. Eastern. Okay. Day trading uses micros and mini futures. And again, we have two sizes of accounts, which you'll see, and you will see the results as of yesterday. Okay. Trades are done in block orders, which means that everybody gets the same fill. There isn't, you get better than me, I get better than you. We all get the exact same fill because they're done in a block. Okay. And all trades are executed by the Capital Trading Group, which is a broker, okay, who is partnered in this event. And they actually are responsible for all the trades, and you'll hear more about them as well. But we have two models, okay? We have a regular and an aggressive. Okay, now here's the results. It goes, this model goes back to when it was available to the public, which is December 3rd of last year. You can see every day, but here, okay, you're seeing, what I do? Did I screw something up here? Hold on, there we go. Through May 18th, this is what I want. Okay, this is through yesterday. Okay, and this is from April 8th. It doesn't matter. You can have it. You'll see every single day, every Saturday morning, I send out a report with a spreadsheet showing every single day from inception. Okay, with an equity curve and a results. Okay, we don't hide from results. If it's a bad week, it's a bad week. If it's a good week, it's a good week. We don't try to hide from it. But our regular model takes $10,000 account. Okay. And here is the regular, which is a 14% since inception. Okay, here's the equity curve. You can see it right in front of you. Okay, the minimum and maximum trade. And it's, again, this takes a $10,000 account and it uses micros only. Okay. The aggressive model, before I get there, I'm sorry. These methods are audited as well. Okay, because there's a broker involved, this must be audited. And so this goes to every month, this goes to audit, and I put out the monthly results for you. Okay. Here is the aggressive, which is obviously up about 10 times or 5 times what the regular is. Why? Because first of all, it takes 30,000 for the aggressive. Okay. The aggressive is going to trade the mini products on the equities, half of a regular crude, half of gold. So it's trading about 5 to 10 times bigger than, of course, the regular. And that really depends on your risk. You shouldn't be looking at this and saying, well, oh, I love that return better. It should be, what am I comfortable with before? Okay. So these are the things that we look at and we watch. And of course, we trade. If there's a trade like today, we haven't had a trade today. And looking at my big monitor here, with the algorithm on it, I don't think there's going to be a trade today. I think we're going to be sitting here doing nothing today, which is fine. We don't force trades because we have an opinion. Okay, we're not interested in forcing something. We are trading the market as it tells us what to do based on the algorithm itself. Okay, and of course these results are audited as well. And I should have had into April, but whatever. I do have it. I just must have missed putting it in here. But letter of direction trading is a process is executed on your behalf, and all they can do, all that the broker can do, is execute the trades that are authorized by the system which you authorize. They cannot trade outside of that scope whatsoever. Okay, you can add or withdraw funds at any time. You have full control of your account. You can stop trading and close your account at any time. There is no contract, no restrictions as to what you can do with your money. CTG can only execute the trade signals that are given by our systems. Okay, there is no other thing they can do in this model. They have no control over your account whatsoever, other than to make these particular trades. Now, what are the benefits of auto trading it? You don't have to pay data fees. Okay, it removes your emotions from an investor. You maintain control over your account. Stop whenever you want. All clients get the same price for execution. No pattern day trading restrictions, and of course, Rule 1256 tax breaks. Now, what is that? Futures are run at a better tax rate than, that's a stop word of mine. Don't worry about it. It's something just got stopped out. Rule 1256 is 60/40. If you have ever traded the SPX, that also use it. So it's a better tax structure for traders as well. But check with your tax professional. Don't take my word for it. You can check with them. But it's Rule 1256 is 60/40 tax. Okay. Now, who is Capital Trading Group? Well, they've been in business since 2006. But Nell and Pat have been on the trading floor, and I know them back from the 80s. Okay, when they worked for Chicago Corp and Beige and those guys. Okay, and we go way back, which is why I trust them to do this letter of direction trading. They're very experienced. They've got big money under management, and they know exactly what to do. Okay, and they're going to do it the best way they can. Plus the fact that if there's a question or a problem, they answer the phone. You don't get stuck in voicemail jet. Okay, and again, the 60/40 tax treatment, just check with your accountant. Okay, please. Again, I want you to understand that it's available, but I also want you to, check with your accountant before you do anything that I tell you and take it as gospel. It is gospel, but again, always check with your tax professional before you do anything. Okay. Now, how does it work? You open up a brokerage account with CTG. Okay, you say you fund it with 10, or you fund it with 30,000, or you fund it with more. Now, I'm a big believer from my side of the fence that you should always start with, if you want to go to the aggressive model, you start with 30. Even if you have 100, you start with 30. Why? Because you need to see the model in action, because you need to see what goes on. You always have time to add more. Okay. What I want people to do, I love to educate people on that. If you're right, and if I'm telling you the straight story, which I am, but if I'm telling you this truthfully, then if you miss a few trades in the beginning because you didn't invest as much as you want to do, what's the difference? It's going to work anyways, and you'll make it eventually. But you first need to become emotionally, mentally comfortable with what we're doing. Okay. So I always say, start with the minimums. I got guys that have millions in this model. Okay. But that doesn't mean that should be you. They all started the same way, at the smallest level. Okay. The CTG executes a trade to your account. Any live trade variance across account block, client block, are averaged across all clients. Okay. Client can see trades once they are allocated. Now that's a big thing. Now, because we are doing bulk, the trade will appear in your account, but it may not be 100% accurate until the end of the day, because again, there has to be an allocation, and depending on the exit. So at the end of the day, everybody has the same exact result, and I send them out. In the afternoon, I post them in the chat room how we did, good or bad. Okay, but you can also go to your online portal and see what's going on. And eventually I will start emailing out the trades. And I could never do this and allow you to trade it by yourself because I couldn't get you the information fast enough. This is bang, it's got to be done when it's got to be done. Okay. And how do you keep track of your account? Well, again, you keep track of your account through your daily statements that you get. You can either look on your online portal. You can look at your daily statement that's emailed to you. Okay. And you're going to get a 1099 at the end of the year. You'll have access to reviewing anytime you want. I mean, I look at my account all the time. Again, I may not look at it right at the close. I may not have time, but I may look at it. I start at 1:30 in the morning every day. Okay, so to me, it's just a matter of when I want to check it. I'm not worried about it. I know how we did, so I don't worry about it. But again, people want to see, so hey, it's always available for you. And the big difference again, when you talk about futures versus options trading, okay? Look, I'm both. I was originally started just before 1980 in the options, the CBOE. I was one of the guys in the CBOE that we were on before they built their own trading floor, okay? So I go way back, and I'm not against options, but I think options serve a better purpose. And trying to day trade them with, first of all, the implied volatility and the wide bid offer spreads they create, I think you're cruising for trouble when you start trying to do that. Okay, with the cost and the slippage that you're going to get, because you cannot avoid it on the bid offer spread. So that's something that's very important to understand, that futures are a much better trade for the individual trade. Okay, it gives you an ability to trade something that is pure, that is natural, and that trades 24 hours a day. Okay, not that you trade 24 hours a day. We certainly don't trade 24 hours a day, but you have that option to do that. Okay, you're not stopped at the close. So if you go back and remember what we talked about, we only trade the original pit hours. And again, if you just look at volumes, okay, I'm just going to share this. I'm just going to drag this over real quick. Okay, but if you look at any given product, okay, let me set this up for you guys. Okay, so it is now. Let's hear. We're going to set this up on a 4 minutes because that's why I trade in the morning anyways with my members, okay, who are part of my day trading world. Now, so you look, you can see that the volume spikes up in between the actual trading hours. Okay, this is the overnight trade, and that is consistent with every product in the marketplace. Okay, and every market that opens up, it trades heavier during what were once the original pit hours. Okay, it doesn't matter what they are, they all trade. Here's the actual opening of the pit here. Okay, so you can always see that overnight there's very few opportunities, and of course there's not much liquidity. So you want, when you're trading, you want to trade into liquid markets. Okay, it's always about liquidity. Okay, is what you're looking for. Okay, that's what we want to make sure that you understand, is the liquidity. Okay, and that's what makes the futures market so much better. Now, you can look, wherever you wish, but remember that destiny is not a matter of chance, but a matter of choice. Not something to wish for, but to attain. And I think, again, when you look at models and you look at your track record, your own personal track record of success or failure over the years, I think you realize that we all need to do something that reins in our opinion. You got all the screaming guys on TV telling you that the world's coming to an end or whatever. Now, with me, I tell it like it is all the time. I mean, if you've ever seen me on air, I do. Tomorrow I'll be on Fox at 3:55 with Liz Kleiman. Okay, but again, I tell it like it is. I just say, here, this is our positions. This is what we're doing. Every day I send you a daily update just on general market conditions in case you are trading by yourself. So I give you as much information as education as I can, plus the fact you get to come to my Monday night strategy call as well as part of the package today, which is basically talking about the things that are affecting markets, but actually looking at a number of charts as well. So what I'm trying to help you do is not only help you make more money, okay, in your own trading, but also help you make money in our model, because that'll help subsidize some of the tradings that some of us make when we're not using that model. Okay, so remember, again, it's not something to wish for, but you can attain it, and that's what you're trying to do here. And if you'd like to join me, okay, in our quest and in our journey, okay, you can take advantage now, and that is day trading futures, which with all the executions done by Capital Trading Group. Okay, and by the way, the results you saw were net after all expenses, after all fees. Those were net profits, not waiting for fees. Okay, no overnight risk. Okay, all trades are determined by the proprietary algorithm. No emotions. For 50 people, the first 50 get $99 a month or $800 annually. Okay, and if you wanted to take advantage today, it's bubbatrading.com/dream. That's bubbatrading.com/dream, and you can join me and the others who are enjoying immensely the programs that we do, because our programs do well, because I am, after all, I'm involved, and I'm not interested in selling something that I'm not going to trade myself. Okay, that is always something that I believe in, and I think that you need to always have an understanding for. Okay, so I'll be happy to take any questions that you may have. I know it's been a long day for you guys, and I think I'm the cleanup guy. So, I don't want to keep you longer than I have to. So if you have any questions, please feel free to ask. But it's bubbatrading.com/dream. That is bubbatrading.com/dream. If you'd like to be a member and join me, okay, and you can get started as soon as you get your account open. And once you do sign up, I'll send you and Nell Sloan the information. She will reach out to you, okay, and and get you all hooked up and set up with the futures account that goes with Capital Trading Group. So if there's any questions, please feel free to fire in. I did just log on. Is that I have a chat room, okay? That is, we don't trade in the chat room. I don't have a trading room, okay? I have a chat room. My members are there discussing all day some of the different things going on, the trades that we're in, so on and so forth, okay? Have you got a track record publishing? I showed you the track record. I mean, if you want me to send it to you directly, I'll send you. Listen, I don't care. I'm happy to send you. I'm full disclosure, okay? Again, I'm too old to be trying to do anything fancy, right? I don't have to even do this, but I do enjoy educating people, and I like people to make money, and I'm tired of watching all the scams that are out there on a daily basis. So I chose to take this route and become an educator as well as, I mean, that's just kind of what I do. I like to teach, I like to coach. So again, if you'd like to come in aboard, it's bubbatrading.com/dream. And I'll take, the first 50 at those prices because it's normally $199 and $2,000. Okay. So if you have any questions, please fire them away. And if not, Anna, you get done early because, I was faster than I thought, but I didn't want to miss out, and I want to make sure everybody got everything. So let me know what you might, if you have any questions again, and it's bubbatrading.com/dream. If you want to reach out to me, here's my contact information, bubbatrading.com. There's the website. And again, I'm happy to answer any of your questions at any time. Okay. So, all right, well, I guess nobody's got questions, and Anna, I guess you can call it a day.
Yes, thank you so much, Todd. I just posted the link into the chat box that if anyone could have a question, could reach out to you without any problems.
Great. And listen, thank you so much for having me. I always appreciate being with you. And, it's 45 minutes is always tough for me. So I short timed it versus long timed it, unfortunately. But it's all good because I'm always around to answer anyways and help people out. So if you got any questions, again, feel free to reach out to me via email. Anna, thank you so much. And everybody, thanks for sitting through and being patient. I know it's been a long day, so have a great day, have a great weekend, and be safe, everybody. We'll see you next time we're on the neighborhood. Thanks, Anna.